Welcome to Module B on risk management. In today's dynamic banking and financial environment, risk is unavoidable. But unmanaged risk can seriously affect the stability and profitability of an institution. In this module, we will understand that what risk is and why risk management is essential and how banks systematically handles different types of risk. We will cover key areas such as credit risk, market risk, liquidity risk, operational risk, and along with the tools and techniques which are used to identify, measure, monitor, and control these risks. The concepts will be explained in the simple language, supported by some practical banking examples and exam oriented points. By the end of this module, you will have a clear understanding of risk management and its importance in ensuring the financial stability and regulatory compliance. So let's begin module B. So let's start with our very first unit of module B, unit 11, that is risk and basic risk management framework. So according to you, what is risk? Can you tell me that what is risk? Obviously, any unexpected situation is risk. And even we compare that risk is common in humans' life as well as in the business life or for a company, for a human, for everyone, there is the risk. Risk means when unexpected profit or loss. Negatively, if we see that this is the uncertainty about the future outcomes. Basically, losses in the case of a business, right, or a bank. But in a human's life, always there are lots of risk available like illness or anything, accident, death. These all are the examples of risk. So risk means possibility of loss or uncertainty about future outcomes, right? In a business, as a businessman or as a bank management, in the bank management system, people or senior board of directors, senior department, they take the risk. Risk is directly related with the returns. If a business takes risk, there is a chance of profit or maybe loss. So that word risk comes from where? Italian word risicare, which means to dare to take a challenge. In bank and finance, risk mainly arises because future cash inflows and outflows are uncertain. Anybody in the business, they don't know what happens, what will be happen in the future. So they are doing planning according to the circumstances, every circumstances. That's why in the ABM, you read about the planning, organizing, directing, controlling, and staffing, right? So, if future income is sure, expenses are also sure. I know that I have to pay electricity bills, I have to pay internet bills. I know that my income is that I have to pay these bills. There is no risk. I have to make sure these bills are paid. Risk exists only when outcomes are uncertain. Maybe I'm taking the class with the help of Wi Fi. By chance, if there is any problem in that Wi Fi occurs, that class will create problem, right? So, that is also the example of operational risk in the case of bank and finance. Operational risk, which comes due to failure of process, people, or human, some external events which are beyond the control of humans, like COVID-19 situation, right? So if bank gives a loan 10 lakh to a customer, if customer repays on time, there is no loss. But if by chance that customer defaults, that customer is not able to pay the bill, the loan, that is credit risk. That is the loss to the bank, and that risk is called credit risk, where the borrower defaults. So, that type of uncertainty is also called the risk. So, risk is available everywhere. But the main thing is how to manage this risk. We will learn these things in this chapter, and for every risk, there is a separate chapter dedicated to that risk in which we learn how to manage, what are the strategies, what is risk, and also lots of numericals. So, we will learn the numericals also in the very next chapter. We have numericals like CRAR calculation, and how to calculate NPAs, how to calculate the tier 1 capital, tier 2 capital, and these all are important from the exam point of view, because in every cycle the questions are from these particular topics, either in the form of case study, either in the form of numericals, right? So I hope that now it is clear that what is the meaning of risk. That there is one person, Warren Buffett. Warren Buffett, according to Warren Buffett, what is the risk? Warren Buffett said, risk comes from not knowing what are you doing, right? Means risk does not come from business itself. Risk comes from lack of knowledge, poor analysis, and wrong decision. And obviously, if there is a very poor management in any company or in any business, so obviously the chances of losses are very high there, right? So risk does not come from business itself. It comes from lack of knowledge, poor analysis, and also wrong decisions. Suppose giving a loan after proper credit appraisal, there is a lower risk. When banks check their borrowers clearly by evaluating everything, that means there is a chance that borrower will not default. But if by chance a bank gives a loan without checking income, collateral, repayment capacity, there is very high risk. So it is very important to check the borrower, that what is the credit worthiness, what is the credit rating, is there any migration in their credit rating, everything you will learn in the chapter credit risk, right? Relate when the risk related to the borrower, that is called credit risk. So, what is the meaning of risk adjusted return on capital? A very last chapter in module D, we have RAROC, which is very important concept. What is the meaning of RAROC? What is the meaning of that RAROC? Basically, that is a type of financial metric, or we can say that measures the investment returns while keeping the risk in the mind. This helps, or you can say, in the other words, this is a profitability measurement framework for analyzing risk adjusted financial performance, right? And this RAROC framework generally help the banks to make better credit decisions when approving, structuring, or pricing deals, right? So that is risk. It is a metric which is used to assess the profitability of an investment project or even an entire business, right? So it measures profit earned after considering the risk taken. RAROC shows how much return is earned for each unit of risk. Why this RAROC is important? Because it helps the banks in comparing performance of branches, departments, and the business units. It encourages quality business, not just high volume business, because that is not necessary for a business. For a business, it is important to survive in the competitive market. So, higher RAROC means a very good performance. But if the RAROC is lower, that means poor risk adjusted performance. So RAROC is a profitability measurement of an organization, of entire business or investment project, anything, right? That is the RAROC. Example, if branch A profit is very high, so obviously the level of risk is also high. RAROC is low, so decision is not preferred. Branch A is not good. Branch B, moderate profit, risk level is low, RAROC high. So obviously investment options are better for branch B. If it does not matter that branch A earns more profit, branch B is better because it earns more return per unit of risk. So for the banks, it is mandatory to manage the risk. Now, what is the basic risk management framework? How banks manage their risk? Risk management is completely a systemic process in which first we have to identify the risk. That what is the level of the risk? Then we have to measure the risk. That how severe the risk is. Then implement all the plans and then monitor the risk and control the risk. So four processes there: identify, measure, monitor, control. But six pillars of risk management, which is very important while doing the risk management. First is here the organization for risk management, how to identify the risk, how to measure the risk, how to do the risk pricing, risk monitoring and control, and then risk mitigation, reduction of the risk. So, first, we will learn about organization. Who are involved behind the risk management? This defines who is responsible for managing the risk in the banks. Who is responsible? Obviously, on the top, we have board of directors, highest authority in the bank. They decides overall risk appetite. What is risk appetite? And this is a term in the banks that basically where the bank limits or bank willingness that how much how much the risk a bank can take to earning the profit, right? So how much the risk a bank can take, that limit is called risk appetite. It also approves risk policies. So board decides we will focus more on retail loans than risky corporate loans, right? So that is completely depends on the decision of the board, right? Board decides that whatever the decision of the board, then senior management, risk management committee, elco, every department will work according to the decision of the board of directors, right? Then after the board of directors, we have here risk management committee of the board. Risk management committee of the board. In short, you can say that RMCB, right? It acts, it acts, but on the behalf of board of directors, because board of directors can't do everything. So they assign this committee. This committee acts on the behalf of the board of directors. How? They reviews the risk reports regularly, right? Also, they ensures proper implementation should be there of the risk policies, whatever the risk policies approved by the board, right? Example, reviewing the rising NPAs, NPAs, non-performing assets in the MSME loans, and then RMCB suggest some corrective actions, right? Then we have, see, after this committee, senior level committee, which you can say this is subgroups, right? These committees handles specific types of risk. These committee handles specific types of risk, like ELCO.
in which first we have ELCO. What is ELCO? Asset Liability Committee, which main focus interest rate risk, liquidity risk, and they manage the maturity mismatch between assets and liabilities. They decide the interest rate, that how much interest rates will be there on the deposits and the loans, because we know that deposits are short term but loans are long term, so that mismatch is managed by the LP, because that mismatch is completely responsible for liquidity risk. Now, what is liquidity risk? When the shortage of cash is there, when banks are not able to fulfill their obligation just due to shortage of cash, and that creates panic between the depositors. Suppose, as a human, if someone know that there is a shortage in the bank of the there is a shortage of the cash in the banks are unable to pay the depositors, so that will create the problem in the market, that leads to the reputational risk. So every risk is even connected with each other. Why every risk is connected each other? That for that we have the concept interconnectedness of the risk, where all.
So just give me a minute. I think my mic is not connected. Okay, so I think we can start here. I'm audible. Okay, so I'm saying that about the credit risk management committee. After for this committee, it mainly focus on credit risk where the borrower defaults. They frame the credit policies. They set the exposure limits, that how much exposure is okay. They monitor the NPAs and the stress assets. So limiting the loan exposure to one corporate group is not a good thing. Means, suppose if a bank is there and that bank is only giving loans to the housing sector, every loan to the housing sector, that creates problem. Suppose in that condition, if that housing loan sectors declines, that will create the problem for the bank, huge losses there. So that's why credit risk management committee sets the exposure for these types of problem, right? And tightening the rooms when default rate increases, tightening the norms when the these default rate increases, right? So what is the meaning of operational risk management committee? What is operational risk? Operational risk means when the risk occurs due to a process, a failure of process, people, and external events. Operational risk includes fraud, system failure, human failure, process failure. Example, ATM cash fraud, wrong data entry by staff, server breakdown attracting the transactions. So this ORMC ensures control, audit and preventive measures. Right? Risk Management Support Group Department. This is the backbone of risk management. they collect the data, they prepare the risk report, they help in management in taking the decisions, they prepare stress test reports. Now what is a stress test? Every term is important. Stress test, basically you can say that this is actually giving the situations to the banks, that how banks will react in the severe situation, right? That we can is the stress test, right? This is also a very important thing when in terms of banking. It is type of a thing when how the bank will react in severe economic stress, like deep recession, market crash, everything. That is called stress test, right? So, and also risk management helps in calculating RAROC for the business units. So this is risk management, a support group. It is also a subgroup. So you can say that here risk means uncertainty of cash flows, RAROC return adjusted for risk, ELCO liquidity plus interest rate risk, CRMC credit risk, ORMC is related to the operational risk, and board they set the risk appetite and the policies. Then we have risk identification. Now, identification means obviously to identify a possible risk, whatever the available in any organization, either before giving a loan, before making any type of forex deal or any investment. It can be done at the transaction level, portfolio level, capital level. And what are the types of risk are here? Credit risk, when the borrower default, market risk, when the market factors are changed and due to these factors risk occurred, that is called market risk. Liquidity risk, when there is shortage of cash. Operational risk, when there is failure of people, process and some events which are beyond the control of banks. Country or sovereign risk, when there is the restrictions in the country. Interest rate risk, fluctuations in the interest rates. Forex risk, exchange rate fluctuations, right? That is the risk identification. So these are the types of things which are identified. So suppose possible risks are there: company may default, credit risk; interest rate may rise, interest rate risk; steel prices may fall, market risk. In what case? When a bank gives 10 crore loan to a steel company. So if the company defaults, credit risk. If the interest rate may rise, interest rate risk. Steel price falls, market risk. Cash flow mismatch, liquidity risk. So risk identification is the first and most important step in the risk management. Right? Most important, first and most important step in the risk management. Now, risk measurement. Measure the risk, that how the severe the risk is. Risk measurement, how to do risk management? By just answering these questions. How much can we lose? How frequently can loss occur? What will be the impact on earnings and capital? You can take the example of in the daily life. Suppose we have any interview, I have any interview uh, at different place. I have to go that interview at 9 p.m. 9 a.m. sharp, right? Now, before going visiting to the interview spot or interview venue, I have to check the map, I have to arrange the vehicle, I have to arrange a dress obviously, and everything. What if suppose rain is there? What if I will not able to get any vehicle? So these questions are there in my mind. What happen if the interview is not cleared? What type of questions are there they will ask in the interview, right? So, or you can take the example in schools when we give the practicals and our friends are already going for the practicals, so we will ask them that what the examiner is asking. So that fear is called risk. So risk measurement, the bank must measure how the big risk is, These are quantitative measure which can be measured in numbers. And what are the target variables? Earnings, market value, probability of default, how much default can occur, loss given default. So, risk measurement categories we have. First, sensitivity based measure. Sensitivity shows how much our target variable changes when one market factor changes by only 1 unit, how sensible it is. Suppose if interest rate increase by 1%, loan portfolio value falls by 50 lakh. That 50 lakh is sensitivity, right? And then next we have here volatility based measure. Any type of movement create how much risk. Volatility based measures. Volatility means how unstable or fluctuating a variable is over the time. High volatility, high uncertainty. High ups and downs, high uncertainty. If high uncertainty, obviously high risk is there. Right? So, volatility shows ups and downs of the prices. Then downside potential measure, how much loss can occur in the worst case if the worst situation is there. It combines sensitivity, volatility and adverse outcomes. If a bank invests in shares, expected return 12% and worst loss in bad market is minus 20%, so that minus 20% is downside risk, right? And value at risk is basically a tool which measures the severe loss in any situation. So maximum loss of 10 crore in one day with 99% confidence, it is value at risk. Downside risk always focuses only on losses, not on the profit, right? Now we have one more thing, risk pricing. What is the meaning of risk pricing? Risk pricing means charging the customer according to the risk taken. Higher risk, higher interest rate. Lower risk, lower interest rate. Why risk pricing? Because risk consumes capital, risk consumes funds, risk consumes management effort. So, interest paid on deposits and borrowings, that is the component of the risk pricing. Operating expenses, staff cost, branch expenses, technology cost, loss probabilities, chance of the default, capital charge. These all are the, we can say, the components of the risk pricing, right? Then risk monitoring and control. Once the risk is taken, it must be continuously watched and controlled. And monitoring is important. Even in the business, we have 5 basic principles of management, and one of the principle is controlling. Controlling is very important. Every report must be reviewed. Every implementation must be there. Separate risk management framework is there for every risk, right? So risk periodical review, robust audit system in which internal audit, concurrent audit, RBI inspection. So monitoring always converts unknown risk into the manageable risk, because management is very important, right? Management is very important, and with the help of management, so many risks are managed, right? Now risk mitigation, which is the last step. Risk mitigation reduction, how much risk can be reduced with the proper planning. It also limits extra profit, because higher safety means lower return. So risk mitigation techniques: collateral, keep the collateral while giving the loan; guarantees, insurance, diversification spreads the risk, basically reduces the risk; Hedging, exposure limits. So exporter hedges US dollar receivable, loss is avoided. Loan secured by property, credit risk is reduced. If less risk is there, less loss is there, and super profit is also less. Then we have CCIL, Clearing Corporation of India. What is CCIL? This is a counterparty central counterparty which is established in April 2001. Basically, CCIL stands between buyer and seller and guarantees the settlement. It covered government securities, US dollar INR, forex forwards, money market, but it also helpful in reducing counterparty risk. Now, what is counterparty risk? Counterparty risk is that risk in which there is an agreement between two parties, but one party fulfill their conditions, fulfill everything, and another party is unable to fulfill. That another party creates this counterparty risk. Right? It ensures smooth settlement. It increases market confidence. So CCIL eliminates settlement and counterparty risk. Right? Then the most important concept, EWRM. EWRM, the questions can be there from this one, and in the last cycle we have the question. This is very holistic risk management approach that cover the entire organization, not just one department. It defines organizational objectives. It identifies all the internal and external risk. It prioritizes the risk. It explores mitigation options. It monitors and controls the risk continuously. So, a bank is managing credit risk, market risk, operational risk, reputation risk, cyber risk all together under this one framework. And I told you, integration is important. So, EWRM, you can say integration, continuous organization wide risk management. Right. Then, what is the meaning of this EWRM, ERM? This basically, you can say, enterprise wide risk management is a holistic approach where all the risk of the bank organization identifies, assessed, controlled, monitored together instead of managing risk in silos alone. Risk management is everyone's responsibility, not only the risk department. So first evaluate all the existing risk, then review what is the internal environment, review what is the objective setting process, then after this evaluate the control process, that what is how banks are controlling, how they are doing risk assessment process, and do assessment of risk identification process, assessment of MIS. What is MIS? Management Information System. That is a reel, type of a reel which gives all the information to the banks. This is a type of a aunt in our neighborhoods who have all the information, who is faster than 5G. So that MIS basically provide timely, accurate risk reports to the management. Right? And review of risk monitoring process, then formulate the roadmap to how to implement EWRM. ERM framework, which is a risk response rule. ERM helps the management choosing the best risk response from risk avoidance, which stop the activity completely. Risk reduction. Risk reduction means minimize the probability or impact. right? Risk transfer, which shift the risk to the others, and risk acceptance, where accept the risk within the tolerance, right? So not all the risk can be eliminated, that is not possible. So ERM helps in improving decision making, ensure the compliance with laws, protect the reputation, prevent the financial loss. And what is the structure of EWRM? Very important. 8 components are there of the ERM. 8 components. First, we have internal environment. What is the risk culture and the philosophy? So, internal environment. Then, objective setting. Risk assessment, which identify and measure the risk. Risk response, which avoid, reduce and transfer the risk, right? Then control the activities, which basically includes policies and the procedures. Information and communication is important. And last, measurement, monitoring, you can say. Monitoring, continuous review. And also 4 key business objectives are there: strategic objective, long term goals, operational objectives, efficient use of resources, reporting objectives, reliable financial reporting should be there, and compliance objectives, which is important to follow the rules and regulations and the RBI norms, right? So that is the EW.
Chapter number 12, Risk in Banking Business. So, what are the risks available in the banking business we are going to learn in this chapter? So, let's start with the class. There are lots of risks that are available in the banking business. If we start from the types of risk, credit risk, market risk, liquidity risk, interest rate risk, a lot of types of risk are there. So let's start with the class. If you have any problem, you can ask me in the chat box. And I'm hoping that I am audible. Everything is okay. So let's start with the class. First, we have the term liquidity risk. What is the meaning of this liquidity risk? Liquidity risk is basically, if we say, when a bank is unable to pay or fulfill its obligations, like shortage of cash. When the bank is not having enough cash, that is called liquidity risk. Bank is unable to get enough cash to meet its payment obligations on time or at a reasonable cost. The banking has money on paper, like bank has assets, but not cash when it is urgently needed. That situation is called the liquidity risk. Liquidity risk is an inability to for the banks to obtain funds to meet cash flow obligations at a reasonable rate. So why this liquidity risk is critical for banks, or why this liquidity is that much important for the banks? Because obviously, as a human, if I went to the bank and asked them for my deposit, they have to give me the deposit. But if bank denies at that time that I don't have any cash, so that creates the panic problem. So depositors expect instant withdrawal. Bank have to honor cash withdrawals. cash clearing payments, they have to do loan disbursements, interbank obligations. So even a profitable bank can fail if liquidity is not available. So that's why liquidity risk is one of the dangerous risk, or we can say that is the ICU for the banks. That creates a lot of problems if the banks does not have enough cash to fulfill its requirements. So why this liquidity arises in the banks? Because bank mainly face liquidity risk because they borrow short-term deposits. People deposits their funds only for a short term, like saving, current, short-term FDs. And banks lend long-term loans, home loans, which are there for the years, term loans, infrastructure loans, and that mismatch creates the liquidity problems. Suppose if bank accepts 1 year fixed deposits and bank gives 20-year home loans, and suddenly depositor demands their money and bank cannot instantly recover home loans, that is called the liquidity stress. So in short, when the bank does not have enough cash to fulfill their requirements, that problem is called the liquidity risk, right? So when liquidity is insufficient, when the cash is not there, banks have to borrow also at higher than normal rates, because bank have to take loans to fulfill the demands of the depositors. They have to sell their assets at the discounted prices. Means if the asset is worth of rupees 1 lakh, they have to sell it for the 70,000, 60,000, which creates a loss situation for the banks. This increases the cost and as well as reduces the profitability. And if still liquidity gap cannot be funded, in that case, bank may default, lends to loss of public confidence that can cause bank run or serious impact on financial stability. If liquidity is not there in the banks, that creates the bankruptcy, or that creates a very high problem, very uh, great problem for the banks, right? So having the liquidity, good liquidity is very important for the banks. Now, what are the types of liquidity risk in the banks? First, we have funding risk. What is funding risk? When the bank is unable to replace the funds due to unexpected withdrawals or non-renewal of deposits. Suppose if the customers are there whose renewals are completed, they are not interested in renewal, and also if there is any lots of depositors came suddenly and they need their deposits and they withdrawing their money, that creates the liquidity risk. So that type of funding risk arises when bank is unable to replace the funds. Sudden withdrawal of deposits, non-renewal of bulk wholesale deposits, premature closure of term deposits, that creates the liquidity risk because bank lends on depositors' money, right? That is the main business of the banks. Now, the thing is there that what is the examples of the funding risk? Suppose retail deposit withdrawal. Retail deposit withdrawal means there is any rumor spread in the market that about the bank health. Now, many depositors withdraws their saving at the same time. Bank in that case faces the cash crunch, right? And also wholesale deposit non-renewal means suppose bank has 1000 rupees crore bulk deposits. Now corporate depositors does not renew that thing. Bank immediately find alternative funding. So funding risk is related to the liability side of the balance sheet, right? Then we next have time risk. Time risk when the bank does not receive funds on expected dates. Means, suppose banks have to receive the installments, receive the EMIs from the borrowers, but borrowers are not paying and borrowers are delaying the installments. That creates the problem of the time risk. When the loans are turns into the NPAs, NPAs means when a borrower is not able to pay their loan installments on time for more than 90 days. 90 days, no type of installments paid, that means now the loan become NPA, that borrower loan become NPA. Expected cash flows does not occur on time. Whatever the bank is expecting, that money will come from there, and that source of money inflow is not on time. That creates the time risk, which is a type of a liability risk. Suppose, example, EMI default. First example we can take EMI default. EMI default means bank expects 50 crore in EMI inflow in a month. Large number of borrowers now delays the payment. So that causes liquidity gap, right? Next, asset is turning the NPA, non-performing assets. Means, suppose term loan expected to generate regular cash flow. Borrower defaults, loan become NPA, no inflow, but the bank still has to pay the depositors. So time risk is related to the asset side of the balance sheet. Funding risk is related to the liability side, while this time risk is related to the asset side of the balance sheet. Right? So that is the problematic situation for the banks. Now, funding risk, deposit problem, time risk, loan repayment problem. Liquidity risk arises due to funding long-term assets with short-term liabilities. It refers to the inability of a bank to meet cash flow obligations at reasonable cost. Liquidity shortfall forces bank to borrow at higher rates or sells assets at discount. Major type include funding risk, which is arises from deposit withdrawals, and time risk arising from non-receipt of expected loan repayment. Right? Now the thing is there, what is the difference between funding risk and time risk? Funding risk is related to the liabilities, whereas time risk is related to the assets. What is the main issue? Sudden outflow of funds. Many depositors starts their money withdrawing. That creates liquidity problem. Time risk, when the borrower is not giving payment on time. Example of funding risk is deposit withdrawal. Example of time risk is EMI default. So nature, refinancing problem. Time risk, cash flow timing problem. Right? Now, the most important, call risk, which is also a type of liquidity risk. Call risk arises when the contingent liabilities suddenly become actual liabilities. Now, what is the meaning of this contingent liabilities? Uh, Basically, contingent liabilities, you can think that it is a type of future obligations that depends on the uncertain events. That are the contingent liabilities that may occur, that depends on the outcome of the future events, like product warranties, pending investigations. They all are the example of contingent liability. So when the bank miss profitable opportunities because no enough cash is there, so how can bank adopt any a type of opportunity, avails any type of opportunity? Expected cash does not come, or unexpected payment demand comes suddenly. Lots of people needs their money withdrawal, but payment is not there. Expected cash inflow is not there. That creates the call risk, liquidity risk. Now, how this call risk arises? First, in this crystallization of contingent liabilities. Bank guarantees. Bank is involved in the letter of credit. Bank is also providing standby facilities. These are off balance sheet items. If the customer fails to meet the obligation, bank have to pay immediately. Bank issues bank guarantee of 5 crore. Customer fails to complete the contract. Beneficiary invokes the guarantee. Bank have to pay 5 crore rupees immediately. So there is a sudden liquidity requirement, which is called the call risk. That is called the call risk. That is the example of the call risk. Now, second case is loss of profitable opportunities. Loss of profitable opportunities means if a bank lacks the liquidity, it may not be able to lend when interest rates are high. A bank cannot invest in profitable short-term instruments. Example, suppose market interest rate rise suddenly. Bank could earn high returns by lending in call money market. Bank has no liquid assets or liquid funds. So opportunity loss here. That means call risk is here. Call risk only arises from the contingent liabilities which become real or inability to exploit the profitable opportunities. That is the loss of profitable opportunities, which is the example of which is the type of the call risk. Now, default risk, credit risk. Credit risk is what? When the bank is giving loan to a borrower, that borrower is not able to pay back their installments or their loan principal, interest, anything, which is the problematic situations for the banks because bank suffers loss in that condition. So credit risk is that risk when the borrower or counterparty fails to repay the loan, interest dues as per the agreed terms. Counterparty, why we use this counterparty? Because counterparty risk is that risk in which two parties do their agreement, right? After all the settlement, they do the agreement, but one party is unable to fulfill the obligations that creates the counterparty risk. So that's why the counterparty used here because in the credit risk, borrower is not able to pay the bank that creates the counterparty fails. So credit risk is the potential loss which is arises from the borrower failure to meet the obligations on time at all. So, why this credit risk is important for banks? Loans are the largest assets of the banks. Loans are the largest assets of the banks. Corporate bonds, advances form major income source. Default directly affects profitability, capital adequacy, and as well as asset quality, which is NP, right? So you can say that example, suppose bank gives 10 crore loan, 10 crore rupees loan, term loan. Borrower stop paying EMI. Loan become NPA. Bank suffers that credit loss. Then we have the country risk. What is the meaning of this country risk? Where it basically causes just due to the foreign exchange controls, right? Foreign exchange controls or political instability, as well as economic sanctions, war, or civil unrest, right? Government moratorium on payments. That all causes the country risk. So, suppose if Indian bank lends uh, to a company which is in there in the country X. Now, country X imposes all the forex restrictions. Borrower has money but cannot remit. That is called the country risk. That is called the country risk, where in a country risk, borrower is willing but unable due to government restrictions. Right? Now, what are the types of credit risk? First, counterparty risk, in which a trading partner fails, one party fails or refuses to perform its obligation. This usually arises in interbank and market transactions. It is mostly unsecured. It is short term but having very high impact. So, call money market, it's the common area for this is call money market. Now, the thing is there that what is the meaning of this call money market? Call money market, you can say that it is a specialized short-term financial market for unsecured overnight lending between the banks and the primary dealers, just to try and manage the immediate liquidity mismatches, right? So that is a call money market. One day lending, in which generally happens 2 to 14 days lending or more than 14 days, is called term money. Notice money when 2 to 14 days, call money is one day lending. If bank A is lending 100 crore to bank B in call money market, now next day bank B fails to repay. Bank A faces counterparty risk. So there is no any type of collateral, no security is there. That's why it is risky. It is purely trust-based, default, impact, immediate liquidity. Right? So counterparty risk is a variant of credit risk which is common in interbank unsecured lending. Same country risk, as I told you, when the borrowers or counterparty fails just because of there are restrictions in their country, not because of borrower weakness. Borrower is able, borrower is financially stable, no problem is there with the borrower. But country bans the forex restrictions or any type of restrictions that stops the borrower to pay the exporter. So, what is the nature of country risk? It is external, beyond the borrower's control because borrower can't do anything in that, and it is linked to the sovereign actions. It is purely linked with the sovereign actions. So, that is the problem in the country risk, which basically banks have to face. Now, here we have next operational risk. Very dangerous risk, very famous risk. Why dangerous? Because it occurs due to the failure of people, processes, or some external events. People means employees do the theft, employees leaks the confidential information, employees do any type of misunderstanding between the employees or they do any mistakes. That all are the examples of operational risk in due to the people. Process, failure of technology, no power, failure of windows, all are the examples of the failed process when there is a problem in the technology. External events which are beyond the control of the bank, example, COVID-19 situation. So, operational risk is the risk of loss which is arises from failed processes, human errors, system failures, external events. Operational risk is the risk of loss that is resulted from inadequate or failed internal processes, people, systems, or from external events. And here we can say that any risk other than credit or market risk is broadly operational risk, right? Is broadly the operational risk. What are the examples of operational risk? Process failure, wrong interest calculation, incorrect account posting, people risk, fraud by the employee, negligence, lack of training, systemic risk. System risk is when there is a core bank failure, like cyber attack. External events like natural disasters, power failures, terror attacks. Right? So that all are the example of the operational risk. But there are also the major types of operational risk. First, we have transaction risk. When there are the errors in processing the transactions. when there is the wrong data entry, when there is duplicate or missed transactions, wrong amount credited due to the clerical error, that is the transaction risk. Compliance risk, when there is the failure to comply with laws, rules, or regulations. Penalties from the RBI, SEBI, IFSCA, etc. These all are the examples of the compliance risk. When the people are not following in the banks the guidelines of the FEMA, RBI, and IFSCA. Non-adherence to the AML KYC norms, that means heavy fine is there. That is the example of operational risk. Now, transaction risk is the risk which is arises from internal or external fraud, weak or failed business process, inability to ensure business continuity, and poor information management. Error of fraud while doing day-to-day business banking transaction is the example of transaction risk. What is the source of transaction risk? Internal fraud. Employees misappropriating, fake accounts are there, unauthorized withdrawals are there, branch staff manipulates customer account balances. So, external fraud, ATM skimming, phishing attacks, cyber attacks, fake checks, all are the example of external fraud. Process failure, when wrong posting of entries, duplicate entries, any missed entry. Bank continuity failure, when bank system is failed, power network breakdown, system crash on cell reading, customer unable to withdraw their money. So transaction risk is mainly relates to the day-to-day operational activities. Then we have compliance risk, integrity risk, when this risk is occurs just not following the rules, not following the rules guidelines that creates a problem of penalties, financial loss is there, reputational damage is there, and it is just due to when banks are unable to follow the laws, regulations, code of conduct, and all the best banking practice. But why this is called integrity risk? Because you know that bank reputation mainly depends on ethical conduct, fair dealing, and regulatory discipline. Any violation harms the public trust, right? So, what is the meaning of strategic risk? According to the BCBS, strategic risk is not the part of the operational risk, right? But what is the meaning of this BCBS? Uh, BCBS is basically in you can say that if the full form of BCBS, Basel Committee on Banking Supervision, right? So, Basel Committee on the Banking Supervision, which is basically setting the global body setting standards for bank regulation to ensure the financial stability. That is the BCBS. So, strategic risk is what? When poor management is there. Management is not doing good businesses. Decision problem. Failure to adapt to the industry changes. And there is very strategic problem happens just because of wrong business decisions. So gap between strategy planned and strategy implemented is called strategic risk. Poor business decision, bank enters new market without any expertise. There is the results in the heavy loss. Example, poor business decision, improper implementation, lack of responsiveness. Strategic risk reflects mismatch between objective, resources, and the execution. So, in short, just give me a second, just a minute.
So, sorry for this. So, here, what I'm telling you that poor business decision, improper implementation, there is lack of responsiveness. That right? That happens just because of strategic risk. Now, if I can say in short, that what we have learned up till now, call risk is when the contingent liabilities become actual, credit risk when borrower fails to repay, counterparty risk when interbank unsecured default, country risk external country restrictions, operational risk just because of the process people system failure, strategic and reputation risk is not included by the BCBS. It is just because of the wrong decisions of the management. So, call risk arises when contingent liabilities crystallize into the actual liabilities or when bank miss profitable opportunities due to lack of liquidity. Credit risk, when the borrower or counterparty fails to repay. Counterparty risk is also a form of credit risk, and country risk when due to the external restrictions which is imposed by the country. Operational risk results from failure of uh, process, people, system, or external events, excluding any type of strategic and reputation risk. Right now, what are the examples of the compliance risk? Compliance risk example you can think like when there is not regulatory non-compliance, violation of the RBI norms, poor customer due diligence, selling unsuitable products to the customers. RBI now strongly follow the compliance culture, broad level accountability, as well as risk-based supervision. Compliance risk can cause penalty plus reputation loss simultaneously. Now, what is this reputational loss? Reputational risk. What is the meaning of this reputational risk? Reputation risk arises from the negative public perception about a bank. When customer, uh, the impact of this, just customer loses their confidence. Legal actions are there, withdrawal of the deposits, decline in the business. Reputation risk often amplifies the other risk, right? Then mark to market, which is a practice of valuing the assets at current market price, not at the historical cost. This is the practice of valuing the assets in the today's price. Bank buys the bond at rupees 100, market value falls to 95 rupees. Loss of rupees 5 recognized immediately. It reflects true financial position. It prevents hiding of losses. Then, what is the accrual system of accounting? When the income or expense is recorded, when it is earned or incurred, not when the cash is actually received or paid. It is in the knowledge of the banks that that money is earned, okay, include in the books. If interest is due in March, received in April, still that counted in March, right? Then we have the banking book. What is the meaning of banking book? Basically, banking book includes loans and advances, deposits, borrowings, meaning banking book held all these till the maturity. Actuarial accounting is used here. There is no mark-to-market valuation. Capital charges only for the credit risk. What are the risks faced in this? Liquidity risk, interest rate risk, credit risk, operational risk. Example, you can take home loans and term deposits.
Then we have here trading book, which include marketable assets which are held for trading or short-term profit. Characteristics that are not held till the maturity. There is the MTM valuation. Profit and loss reflects whatever the market movements are there. Government securities, equities, forex holding, commodities, derivatives, these all are the content of the trading book. And what are the risks they face? Market risk, credit risk, operational risk. And off balance sheet exposure is basically when all the things are there in the off balance sheet. These are the contingent liabilities such as guarantees, letter of credit that may become fund based exposures. So, transaction risk arises from fraud, process failure, and inability to manage the information or business continuity. Compliance risk refers to the penalties and reputation loss due to failure to comply with the laws and regulation, and it is also called integrity risk. While strategic risk that arises from poor business decisions or improper implementation of strategies, while the reputational risk arises from negative public opinion. Banking book assets are held till the maturity and follow the accurate accounting, whereas trading book assets are marked to market and exposed mainly to the market risk. So, off balance sheet exposures, I told you, are the contingent liabilities, and major types of risk are also there, like yield curve risk, which is due to the non-parallel shift, basis risk due to the unequal rate movements, reinvestment risk is there, which is uncertainty of the future rates, and net interest position risk due to asset liability structure. Right. So you can see what is the holding period in banking book till the maturity. In the trading book, short term. In accounting, it is accrual, mark to market in the trading book. Capital charge in banking book is credit risk. In trading book, it is market risk. Main risk is liquidity, but in trading book, it is market. In chapter 13, some basic calculations, how to find leverage ratio, how to find CRAR, what is tier 1, what is the meaning of HQLAs, all these things we are going to learn in this chapter. So let's start. This is one of the most important chapter and also includes a lots of numericals. So we will learn this chapter from very scratch, very basic concepts we are going to learn in this chapter. So let's start with the class and starting with solving some questions. So here, I hope that everything is okay. If my screen, my voice is audible. So let's start with the class. Here is the first question that is asking you if leverage ratio is 4.5%. Tier 1 capital of a bank is 11,550 crore. Then what is the bank exposure measure? So first, let me tell you first about the leverage ratio. What is the meaning of leverage ratio? See, leverage ratio, it is a type of financial ratio that measures a company level of debt related to the another financial metric. It is a type of financial ratio that measures a company level of debt which is related to the another financial metric. So, how to find this leverage ratio? Simple formula based question. Leverage ratio is equals to capital measure divided by the exposure measure. Capital measure is equals to the exposure measure. So leverage ratio is given 4.5%. What is the capital measure? 11,550 rupees. And what is the exposure measure? We have to find. So here the exposure, we have to solve this. For this, How can we solve? That become exposure measure is equals to 11,550 divided by 4.5%. That will give you 550 multiplied by 100 divided by 4.5, which is equals to near about rupees 256,666.67 crore. So this is the bank exposure measure. Very simple, very important to learn this formula. Apart from this, I will provide you all the formulas that will help you out. You know, these questions are very simple, but sometimes we have to learn everything just to be uh, just to become able to solve the long questions. Now, the next question is here. If the probability of default is 25%, loss given default is 5%, exposure at default is 3,60,000, then what is the expected loss here? What is the expected loss here? So if I told you what is the meaning of probability of default, it is the chance that borrower will default. What is the meaning of loss given default? It is the percentage lost if default happens. And what is the meaning of exposure at default? It is the total amount at risk when default occurs. So generally, if we have to find the expected loss, that is called probability of default multiply LGD multiply by EAD, which means 25% multiply by 5% multiply by 3,60,000. That will gives you rupees 4,500. And this is the expected loss. This is the answer. Got it? Next question. Based on the CRAR calculation, we have given tier 1 capital, tier 2 capital. We have given different types of loan, their amount, and also the risk weight. These all are in the crore. Okay. Now the first question is there. What is the total risk weight assets of the bank? Total risk weight assets. Can you tell me that what is the meaning of this risk weight assets? See, risk weight assets are just the bank assets which are adjusted by the risk level to determine the required capital. They also ensure stability by just assigning the higher capital reserves to riskier loans, and this is very less for the safer assets. It is completely regulated by the Basel Committee BCBS. Right? So, if I give you some important formulas here, first we have CRAR. What is this CRAR? Capital to risk, capital to risk weighted assets ratio. What is the ratio of this RWA? Capital divided by risk weighted asset. This CRAR is known as also the CAR. CAR means capital adequacy ratio. Now, the first question is here. We have to find the total RWA of the bank.
Total RWA, risk weight assets. How to calculate the risk weight assets? Loan is given. You have to just keep the 10 crore multiply by 90%. Then we have 50 crore and risk weight is given 60%. Plus 5 crore, we have to do it 0%. Plus 80 crore, we have to find the 75%. Then 40, we have risk weight 125%. Then 60 multiply by 150%. So let's start calculating it. It will give you 9 crore in the case. 60% of 50 is 30 crore. Here it will be 0. 75% of 80 is 60 crore. 125% of 40 is 50. And 150% of 60 crore is 90 crore. And when we add it, that will be equal to 239 crore. So that is the way to find the risk weight assets of the company. Clear? That how to find it? Okay. Now, the next question we have to find Tier 2 CRAR. Tier 2 CRAR will be how to find capital adequacy ratio. If we find the particular Tier 2 CRAR, that is equals to Tier 2 capital divided by risk weight assets. How much Tier 2 capital is given? 10 crore. And how much RW we have? 239 crore. So if we solve it, we got here 4 point, when we multiplied this 10 by 239, near about uh, 0.0418. And if we convert it into the percentage, then we got 4.18% after multiplying it by 100. That is the total Tier 2 CRAR. Now, same we have to calculate capital adequacy ratio. Um, what is this capital adequacy ratio? What is the meaning of this capital adequacy ratio? So, capital adequacy ratio, it is a regulatory metric that measures a bank financial strength by comparing its capital to its risk weight assets. Generally, its formula is Tier 1 capital plus Tier 2 capital divided by risk weight assets. How much Tier 1 capital is given? 20 crore, right? And Tier 2 capital is 10 crore. Risk weight asset is 239 crore. So that becomes 30 crore divided by 239 crore, which is equals to 12.55%. This is the answer. Then Tier 1 CRAR ratio will be same for Tier 1 CRAR. Here you have to find Tier 1 capital is divided by RWA. So Tier 1 capital is 20 crore, risk weight asset is 239 crore, which will give you
8.37%. So with the just help of formulas, you can find the correct answers. Got it? As per the RBI guideline, the minimum Tier 1 capital of a bank must be minimum Tier 1 capital. That must be 7%. Let's understand this in uh, detail. We know that in the Tier 1 capital, we include core capital, equity reserves that obviously absorb losses immediately. In Tier 2 capital, we include secondary capital like general loss, reserves, unaudited reserves that cover losses during the wind up. Risk weight assets are those assets which are adjusted for credit, market, and operational risk, with riskier assets which require higher capital. If the CAR indicates a safer, higher CAR means safer, stable bank with a low ratio that suggests high insolvency risk. Now, RBI tells that 9% of capital is important, right? And in this, we can include highest quality capital. According to the RBI, 9% capital must be there, right? And in all over the world, only 8% is there. Why the capital management is very important? Because this is the pillar of the Basel norm, Basel third first pillar, minimum capital requirement, right? Second pillar we have SREP, supervisory review process, right? Third we have the market disclosures. So that is the need of the RBI in that Tier 1 minimum 7% is required, which also comprise minimum of 5.5% of common equity capital. Bank are to require capital conservation buffer in the form of common equity Tier 1 capital, which is 2.5%. So total capital is 11.5%. Tier 2, Tier 1 capital is different. And what is the meaning of this capital conservation buffer, which is very important term? Capital conservation buffer is basically Basel third mandated 2.5 cushion of common tier equity capital that bank have to hold minimum regulatory capital requirement. It forces the banks to build up capital during the good times to deal with the like loss timings, loss situations. Now it is clear. Now, what is the capital adequacy ratio of the bank is? So here, if the RW risk weight asset is 239 crore, so capital needed as per Basel third is 9% of 239 crore, which is nearly about, let me calculate, 21.51 crore, while the bank has 30 crore as the capital. So how much excess is there? 8.49 crore. Capital is there in the excess because it is mentioned in the question they have 30 crore total capital. Got it? Now, the next question, if a 91-day treasury bill after 41 days is trading at 99 rupees, so calculate the yield this treasury bill. What is the meaning of treasury bills? They are short-term, zero coupon debt instruments which are issued by Government of India to manage short-term liquidity needs. They are issued at discount, they are redeemed at face value, they offer a safe, low investment risk for 91, 182, and 364 days, with returns that are derived from the difference in prices. Right? So 91-day bill, we can calculate how? Here we have to calculate yield, right? Yield formula is 100 minus P divided by P multiply 365 days divided by D multiply by 100. What is P here? It's 99. Price. What is D here? That is 50. How? By reducing 91, 41 from the 91. So yield is equals to 100 minus 99 divide by 99 multiply 365 divide by 50 multiply by 100. That will give you 1 by 99 multiply 365 divide by 50 multiply by 100. And then we calculate it, it will be 7.37%. This is the answer. So the most important role of this formula. The questions are actually easy level. I know that thing. And I am including these questions just for your basics are clear. Got this thing? Now, next question. Very important thing I want to tell you here about the HQLAs. HQLAs. So let's discuss about the HQLA, high quality liquid assets. There are two categories of assets which can be included in the HQLA. First, we have level 1, next, we have level 2. And this level 2 is categorized in two levels. Level 2A, this is level 2B. Level 2 assets plus 2A plus 2B, they can be included in the stock of liquid assets. And here only maximum 40% of haircut can be included. In level 1, 60% of HQLA. In level 2, we have 40% of HQLA. Level 2B should be comprised not more than 15% of total stock of HQLA. So level 2A having the 25%, level 2B is having 15%, and total is 40% here. Level 1, 0% of haircut. In level 2A, we have 15% of haircut, and in level 2B, we have 50% of haircut. Is that clear? That what is the HQLA? So if I give you the explanation of this HQLA, HQLA refers to the specific category of financial assets that can be easily converted into the cash with little or no loss of value. Right? And basically, this is a type of requirement of the banks. Right? So, in detail, if I can explain you, HQLA refers to the specific category of financial assets that can be easily and immediately converted into the cash even during the periods of market stress. That concept is introduced under the Basel III regulatory framework. It is developed by the BCBS after the 2008 global financial crisis with the aim to strengthen the bank's liquidity resilience. These HQLAs are playing a very crucial role in ensuring that financial institutions can meet short-term obligations, they can maintain public confidence, and also prevent liquidity-driven crisis. And I told you about the level 1 assets. In this, we can include cash and central bank reserves, government bonds which are issued by highly rated countries. In level 2A, you can include covered bonds with high credit rating, certain government or corporate bonds. In level 2B, you can include equities from major stock indices, corporate debt securities which are rated between A plus and triple B. That all are the example of the HQLAs. Got it? Now, categories, I hope that you are cleared with the categories. So, if the total stock of HQLA of a bank is 60 crore, 2B they are talking about, and 2B we have 15%. 15% of what? 60 crore. So, how much it is equals to? That is equals to 9,000 crore. That is the answer. Right? Very simple. If the total HQLA, now they are only asking level 2 assets. Level 2 assets, we can include 40% of 60 crore. In this, we get 24,000 crores. Got it? Now, if the yearly volatility of the stock is 25%, then you have to estimate the monthly volatility of the stock, assuming there are 252 trading days in a year and 22 trading days in a month. So, according to you, how to calculate it? A good question. So, let's calculate it. Very simple. We know that volatility of time period T is equals to D multiply root T. D is here daily volatility. T is number of days. Yearly volatility is 25% given. Number of days 252 given. So yearly volatility is equals to D multiply root 252. That will give you 25 is equals to D multiply 15.87. So D is equals to 25 divided by 15.87, which is 1.575. Now, volatility for the time period is T is equals to D multiply by root T. So, monthly volatility is equals to 1.75 multiply root 22. That is 1.575 multiply 4.69, which is equals to 7.38675. That means 7.39%. This is the answer. So the complete question is there on the formulas. Is that clear? How to calculate the things? Right? Now, next question. If the bank has 5 lakh in tier 1 capital, and if you are watching this video before, if you have any issue in any question, you just ping me out in the comment section. Bank X has 5 lakh in Tier 1 capital and 2 lakh in Tier 2 capital. Bank X has taken the following exposures only: XYZ 5 lakh with 25% riskiness, PQR 50 lakh with 55% riskiness. So calculate the capital adequacy ratio of the bank. How to calculate? Very simple. I told you the formula that CAR, you can say that what is the eligible capital. Capital uh, means Tier 1, Tier 2 divide by total RWA. And we have 5 lakh with 25% riskiness. So total capital we know that is about 7 lakh. We have to calculate the 25% of this 5 lakh. We got 1,25,000. And 55% of 50 lakh is 27,50,000. Add them, you got here 28,75,000. That is equals to 28,75,000, which will give you 24.35%. That is how to calculate the capital adequacy ratio. Now you are able to find the capital adequacy ratio. Now let's see this question in which all the gross income beta factor is given. First, we have asked what is the capital charge for operational risk as per the basic indicator approach. Very, very simple. First, calculate here the capital charge. And how to calculate the capital charge? Do the 18% of 500, that will give you 90. Same 150, do the 18% of 150, that will give you 27. 12% of 800, 96. 15% of 420, that will give you 63. 18% of 100 is 18. 15% of 340, 51. 12% of 200 is 24. 12% of 56. When you add them, you got 375. Here it equal to 120% and here it is 2560. Now they are asking about the capital. Capital is simple, RWA multiply by 9%. So RWA is equals to capital divide by 0.09. So RWA is 375 divided by 0.09, which will give you 4166.67. Now with this, you have to find capital charge as per the basic indicator approach, that is gross income multiply by alpha, which is for gross income is 2560 multiply by 2560. This is the gross income multiply by 15%. That will give you 384. This is the answer. Now, how it is clear that how to find the capital charge for operation risk as per the BIA. Right now, recently I told you about the CCB. Can you tell me that what is the meaning of this CCB? What is the purpose of this CCB? What is the purpose of capital conservation buffer? C. Capital conservation buffer, which is the part of the Basel III norms. Its main purpose is just to ensure bank build up extra capital in the normal times so they can absorb the losses during the stress period. If the bank capital fails into the CCB range, it is allowed to freely distribute the profit. Restrictions are imposed on dividends, share buybacks, and the bonuses until the bank restores its capital level. This helps bank maintaining the common equity capital requirement. So according to the given option, which option is correct? Option B is correct. To restrict the payouts when breached to meet the common equity capital. Option B is correct here. Got it? Now the next question. What does the RCA app consist of? RCA app. RCA app is regulatory consistency assessment program. That means it is a Basel Committee on Banking Supervision initiative. Its purpose is just to assess whether Basel standards are implemented consistently across the countries. RCAF consists of two main streams. Assessment of Basel standards, check whether the national regulatory correctly adopt Basel norms, examines whether domestic banking regulations are consistent with BCBS requirements. So we can say there are two work streams, Basel third standards, second standards, and regulatory framework consistency. Now let's learn about the Basel norms first. What is the meaning of Basel third norms? What is basically Basel third? See, if we talk about the Basel third, it is known as Third Basel Accord of Basel Standards. It is a regulatory framework which is followed by the voluntary basis on a global scale. Basel norms are the international banking regulation. These are developed by the Basel Committee on Banking Supervision. In 2010, Basel Third Guidelines was released. It was developed by just because of response and shortcomings in financial regulations, which is exposed during the time of financial crisis. And its main objective is just to increase the liquidity of the banks and decrease bank leverage. Three main pillars it have: minimum capital requirement, uh, then second is having SREP, supervisory review process, and liquidity requirements, or you can say that the market disclosure, right? So Basel norms are very important in this. Capital adequacy ratio is also maintained. Bank have to maintain minimum capital adequacy requirement of 8%. In India, according to the RBI, it is 9%, right? And LCR is also a very important ratio which hold a stock buffer of highly quality liquid asset which can sufficiently deal in cash outflows. NSFR is also a ratio that maintain a stable funding profile in relation to the off balance sheet assets and liabilities. So these exposures are subject to several risks, mainly market risk, liquidity risk, where the shortage of cash, and credit and counterparty risk is that risk in which one party is faced to pay the obligations, that is called like one party fails to fulfill their obligation, that is called counterparty risk or credit risk. So, what do you mean by the market risk? This is the risk of loss in the value of trading positions due to unfavorable movements in the market prices during the time taken to liquidate those positions. So, market risk is the risk of loss in the value of trading positions due to unfavorable movement in the market prices. What market prices include? Interest rates, equity prices, foreign exchange rates, commodity prices. Bank mark their trading portfolio to market value. Any adverse movement reduces the profit or create the losses. That is called market risk. If any type of adverse movements are there, that can obviously reduce the profit and creates a loss situation. We can see the example here. Just a second.
I think now I am audible. Now voice is okay. Please confirm that now audible. I changed the mic. Maybe now I am audible. Let me check. Okay. So, thank you for telling me. So, we are discussing about the market risk. Market risk, when the changes are there in the market factors, unfavorable changes that cause loss, is called market risk, right? And any type of adverse movement reduces profit and create the losses. If we see the example of this, suppose that a bank hold government bonds in its trading book, right? Now when a government holds the basically some types of government bonds in its trading book, interest rate rise suddenly and bond price fall. So bank records an MTM loss, mark to market loss. Market risk here materializes. Another example we can take here, suppose a bank is holding US dollar positions. Domestic currency now strengthen. So in this, value of the US dollar position falls. That creates forex market risk, right? So this is the example of market risk. You can just think that whenever the favorable situations are not there in the market or any changes are there in the market factors, that changes causes loss, which is called market risk. Okay. Now, liquidity risk. Liquidity risk is basically when the bank is not able to pay cash or bank is not having enough cash to fulfill their obligations, or difficulty in selling the assets quickly at the fair prices. Assets are not able to sold in the market at the fair prices, that is also called liquidity risk. Liquidity risk in the trading book, trading liquidity risk has two components. First we have asset liquidity risk. Asset liquidity risk arises when a specific instrument or asset becomes illiquid. Asset liquidity risk arises when a special instrument or asset become illiquid. Illiquid means that particular asset is not able to sold in the market at fair prices, right? Market is liquid, but for that asset the problems are there. So that problem with the asset itself, not with the market. What are the causes of it? Because there are complex structured products, there is very low rated corporate bonds, customized derivatives are there, instruments are there with the limited buyers. That is called asset liquidity risk. Market liquidity risk, when the entire market becomes illiquid, when in the entire market there is no liquidity, even even in normally liquid assets cannot be sold without large price impact. Means if the asset value is suppose 90,000 rupees, but in the market the value of that asset become only 10,000, selling value become only 10,000. So that is the problem of market liquidity risk. This problem is system wide, not asset specific, whereas this asset liquidity risk is asset specific. So, what are the causes of this? Financial crisis, panic selling, withdrawal of market makers, sudden regulatory or economic shocks. So, suppose if a bank is there who is hold bond which is issued by a small private company. The bond market overall is active, but very few buyers are interested in that bond. Bank must sell at heavy discount or cannot sell quickly. This is called asset liquidation risk. Whereas market liquidation risk, you can take the example, suppose during the 2008 financial crisis, which is global financial crisis, even government securities faced poor liquidity. Buyers disappeared, there are no buyers available in the market, or bid ask spreads widen sharply, prices falls distractly. That is called market liquidation risk, which is basically systemic wise, right? System wise, not with the particular asset. So asset liquidity risk cause is specific asset illiquid, when one asset become illiquid. Market liquidity risk, when the entire market become illiquid. Market conditions in the asset liquidity risk are normal because only a specific asset is not able to sell in the market. But when the stressed or crisis situation is there, in the market liquidity risk, example, low rated corporate bond is the example of asset liquidity risk. Financial crisis is the example of market liquidity risk. Right? Now, what is the meaning of this credit and counterparty risk? Credit and counterparty risk arises in trading book when arises in the trading book, when obviously the main issuer or the borrower defaults, right? Or when there is the downgrading in the credit rating, downgrading in the credit rating, which reduces market value, right? When there is a downgrading in credit rating which reduces the market value, right? So we can say that this risk exists even without an actual default. So that is credit and counterparty risk. Now, what is credit risk? Credit risk, when the issuer of the security or the borrower is not able to pay interest or the principal. When a bank hold bonds of a company, the company become financially weak, probability of default increases, bond prices fall, loss to bank. Right? That is the example of credit risk. When the borrower is not able to pay the bank's principal or interest, that is called credit risk. Now, counterparty risk, when the one party is not able to fulfill their obligation, risk that the other party in the financial contract fails to meet the obligations. When a bank enters into an interest rate swap, the counterparty defaults before the settlement, bank suffers replacement cost loss. Right? And also, there is one important thing, rating the downgrade risk. means rating the downgrade risk. That means even without default, if credit rating falls. What is credit rating? Credit rating is basically is the history is given to the borrowers according to the history of the borrower. Credit rating falls. Example, if someone having the rating triple A to triple B, right? Now investor demand higher yield, right? Then bond prices falls, right? Or MTM loss occurs. Means here we can say this is called credit migration risk. Now the thing is there, what is the meaning of this MTM? MTM, mark to market, right? Mark to market. What is the meaning of this mark to market? When the investments are there according to the current prices in the market, whatever the actual price that is there for the asset or any type of investment, right? That is called MTM. Now very important thing, market risk management frameworks in the banks. How to do a market risk management framework? Because obviously for a bank it is very important to see that this any type of risk is properly identified, properly measured, properly monitored, controlled, and as well as mitigated, right? So first step is here risk identification. First step is risk identification. Identifying all the types of market related risk that the trading book is exposed to. Identifying that all types of market related risk that the trading book is exposed to. It includes interest rate risk, equity price risk, foreign exchange risk, commodity price risk, liquidity risk, credit spread risk. Means risk identification, in which very first step is just to identify all the risk, right? So what is the example? Here example is a bank trading in forex identifies the exposure to exchange rate volatility. When a bank trading in forex identities, and that is exposure to exchange rate volatility. A bond trading desk identifies the interest rate risk. That is means the very first step in every risk management is just to identify the risk, that what type of risk is that. Then the next step is here we have risk measurement, because after identification measurement is important. Risk measurement. Now in the risk measurement we can say that quantifying that how much risk the bank is taking, and the very common tool for that is value at risk, right? Just a second. Value at risk. What is value at risk? That is the tool which is basically tells about the maximum expected loss under normal market condition. And one more tool is there, stress testing. What is stress testing? losses under the extreme conditions, and also sensitivity measures. Sensitivity measures like duration, beta. Here value at risk shows the bank suppose may lose rupees 10 crore in one day with 99% confidence. A stress test shows losses during a crisis scenario. That is called risk measurement. Then third step is monitoring and control. Now continuous tracking of risk level and ensuring they stay within approved limits, where the key controls are trading limits, stop loss limits, position limits, independent risk management desk. Suppose if a trader has a limit of 100 crore exposure and exposure crosses 90 crore, alerts now are generated. It breaches require senior management approval. Means 100 crore exposure is allowed only, not more than that. Then last step is mitigation, reduction. All the steps are taken just to remove that risk or reduce this risk, because completely elimination is not possible. But yeah, steps can be taken to mitigate that risk. So methods are hedging using derivatives, diversification, reducing positions, improving asset quality, increasing liquidity buffers. So bank hedges interest rate risk using the interest rate swap. Foreign risk is hedged using the forward contracts. That is called risk mitigation. Right? So market risk that arises from the price movements. Liquidity risk that arises from the inability to sell the assets quickly. Credit and counterparty risk arises from default or downgrade. So a strong market risk management framework ensures financial stability and also protect the banks from large trading losses. Clear? Now, organization structure, market risk management. An effective market risk management system in a bank requires very clear rules, independence, and a strong oversight, obviously. The structure ensures that the risk taking, risk measurement, risk control are properly separated. First, top prior level, we have board of directors. Board of directors, they are having the complete responsibility of market risk management in the bank. They approve overall risk appetite of the bank. What is this risk appetite? Risk appetite is the willingness of the bank. Willingness of the bank that the bank can take that much limit of risk. It also approves market risk policies and frameworks. It also ensures adequate capital allocation for the market risk. It reviews major risk exposures and limit breaches. So board of directors having the overall responsibility. If the bank decides to increase trading in derivative, the board approves maximum exposure limit and what is the capital required for such type of activity. Then we have risk management committee, a committee of the board which is responsible for policy level supervision of risk. A committee of the board responsible for policy level supervision of risk. It reviews market risk reports periodically. It monitors the compliance with approved risk appetite. It ensures independence of risk management function. It reviews stress test results and value at risk trends. So if the value at risk increases sharply in the movement markets, that risk management committee evaluates whether trading limits need tightening or not. Then we have ALCO, Asset Liability Management Committee. This is Senior Management Committee. Senior Management Committee that is basically responsible for managing balance sheet and market risk. It manages interest rate risk, liquidity risk, foreign exchange risk. It sets the trading limits and also the stop loss limits. It reviews the market conditions and always also funding strategies. It ensures profitability is there within the risk limits. Example, suppose if interest rates are expected to rise, so ELCO may reduce the long term bond holding or increase floating rate assets. Right? Then we have ALM support group, market risk group. This group provides analytical and technical support to the ELCO because it helps in measuring the market risk. It prepares the risk report for the ELCO and the senior management. It monitors limit utilization. It conducts scenario analysis. So if a group calculate interest rate sensitivity of the trading book and then submits reports to the ELCO. Right? Then middle office, which is independent risk control unit, which is separate from the front office, because front office is mainly trading desk. Middle office is doing daily mark to market valuations. It's do value at risk calculation and monitoring. It limits the compliance check. It reporting to breaches to the management. So if a trading exceeds approved limit, the middle office escalates the issue immediately. Right? So risk identification, when all the market risk associated with the products and activities and they are recognized before the trading. But what is this product program? Product program is a detailed document that defines what are the product features, what are the characteristics of the risk, what are the operating procedures, what are the limits and control. All the standard products must have an approved product program. Risk taking units must operate strictly within it. Right? And one more thing is there, which is PTM, product transaction memorandum. What is it? Basically, this is a temporary approval document for the new products. For non-standard or complex products, it is used until a full product program is prepared. So if a bank wants to start trading a new derivative, it first have to approve or operate under the PTM with some restrict limits. Got it? Now, risk measurement happens with two types of things. First, we have sensitivity, which how much the value of a portfolio changes due to small change in the risk factor. and downside potential, which measures possible losses under the uncertainty. Value at risk is the maximum expected loss. Uh, Basically, it tells about the maximum worst loss that the bank can face, right? And why this value at risk is very useful? Because it protects the depositors, shareholders, and the bank franchise. It converts the complex exposures into PNL impact. It aggregate all the risk across products and market. It meet regulatory and disclosure requirements. It is accepted by the banks, regulators, and academicians. It provide a probabilistic measure of loss, but not a worst case loss. It ignores all the market conditions. It assumes that everything is normal. It does not indicate the size of loss. It should not be used alone. So it should be used with stress testing, scenario analysis, and sensitivity analysis. Now the important concept is there, back testing. What is the meaning of this back testing? It is the process of comparing value at risk predicted by the risk model with the actual profit or loss of the trading portfolio. Basically, it compares the process of value at risk predictions and whatever the real model is there. So it helps to check how accurate and reliable the value at risk model is. Why the back testing is done? Just to evaluating a new value at risk model, to assess the accuracy of an existing model, to identify the model weakness, to comply with the regulatory requirements, and actual losses compared here with the value at risk. If the actual loss exceeds value at risk, that is the exceptional case, right? Then back testing always checks whether the predicted risk matches reality or not. Stress testing measures the impact of extreme but plausible market movements on the portfolio. It gives the banks that situation, that how the banks will react in the worst situation. It captures all the tail risk. It assesses the capital adequacy under the stress. So if interest rate rise suddenly by 3%, equity market price falls by 30%, currency depreciates by 20%, so that resulting is calculated, which is called stress loss. So market condition in the value at risk is normal. In the stress test, it is extreme. Probability, yes, used in value at risk. In stress test, there is no work of probability. In value at risk, focus is expected loss. In stress test, basically the severe loss. And what makes a good stress test? Obviously, relevancy, which covers all the key market variables, which considers the regime shifts, which considers the market illiquidity, and also capture interaction of the risk. So what is the limitation of the stress testing? That there is no probability assigned to stress outcomes. Stress scenarios may appear arbitrary, which is very difficult to compare stress test results across the bank. Very high IT and system cost. This stress testing is judgment based, not the statistical. And then risk monitoring, which is very important to do the risk monitoring. Risk reporting is the last step, which every report of the risk should be timely, accurate, which include written commentary, concise, and also it should be focused. And the thing is there that value at risk measures only the normal risk, right? Stress test measures extreme risk, whereas back testing validates the model accuracy. So you can say that what are the risk mitigation strategies are there? Strategies: use the sensitivity measure, use the correlation measures, and use the market instruments, right? And obviously reports need clear communication of the risk. The overview of that: credit risk. What is the meaning of credit risk? When the borrower is not able to pay bank loan, either principal amount, either interest, that loss is called credit risk, right? That is the example of credit risk. That is the meaning of credit risk. So credit risk arises mainly from the lending activities of a bank, because bank gives the loan to a borrower. Now borrower becomes default, not able to pay back the bank either interest, either principal amount. So it is the risk that the borrower, customer, fails to repay interest or principal, either installments or the full amount, as per the agreed terms. And obviously when the loan is not payable for more than 90 days, that become the NPA, or NPA is the loss for the banks. So credit risk can be arises in two situations: in term loans or in EMI based loans. Borrower does not pay interest or installments on due dates, right? Or borrower fails to repay when the bank asks for repayment. That is demand loans, which is payable on demand. So the problem is there with the borrower. Borrower is not paying the bank loan, bank interest or principal interest, principal or installments. That is the called the credit risk, right? We can take the example of this credit risk. You can take, just suppose a bank gives a loan, home loan of 30 lakh. The borrower have to pay EMI per month. If the borrower misses EMI for several months, in that case credit risk arises. Another example: if a company is giving a cash credit limit, bank asks the company to regularize or repay the dues. Now company is unable to pay. That is the example of credit risk. That is the example of what? Credit risk. Clear? Now, for every risk there is a management framework. Credit risk management means systemic process by which a bank first identifies the credit risk, measures how big the risk is, monitors and controls it, reduces or transfers the risk. This framework is divided into 4 parts. The framework is divided into 4 parts. First, credit risk identification. Credit risk identification means finding out where and how the credit risk can arise before or after giving a loan. Credit risk identification, just finding that how the credit risk can arise and where it arises. What banks identify? Who is the borrower? What is the purpose of the loan? what is the borrower's repayment capacity, which sector the borrower belongs to, is there concentration in one industry or group. Concentration means the bank is giving only one sector, the lots of loan to a one sector only, the housing sector or the steel company. Now that steel company or housing company is on their decline phase, so obviously bank will face. So that's how the credit risk is identified, right? The first step is credit risk identification. Okay, now second, for the credit risk identification, basically which type of tools are used, they checks the KYC, they do the KYC, and obviously they check the background checks, like what is the financial stability of the borrower, what is the history of the borrower, is the borrower is willing to pay the loan or not. So KYC and background check. Then they check the financial statements. After financial statements, they check the civil score, right? And also relate industry and sector analysis related to the borrower. Right? So if bank notices that it has given too many loans to a real estate sector, if the real estate market slows down, many borrowers may default. So bank identifies that this is a potential credit risk, right? That bank in that case identifies this is as the potential credit risk. So first step is identification. Next, measurement. Same thing like there is in the market risk. Measurement means what is the level of the risk involved in loan or any portfolio. Simply how risky the loan is. And how bank measure this thing? By checking that the borrower credit rating, is it having triple A or AA or only A or triple B, probability of default, loss given default, exposure at default. Now the thing is there, what is the meaning of this probability of default? Probability of default, you can say, is the chance that a borrower will default. LGD, loss given default, is the percentage lost if they do, and exposure at default is the total amount at risk with when default happens. And they are just used to calculate together to find the expected losses, right? So in the credit risk management, basically common methods are when internal credit rating models are checked, external credit rating agencies gives the credit rating, and risk weight assets calculation. Now the thing is there, what is the meaning of this risk weight assets? So risk weight assets, you can say, are a type of thing that adjusts the value of assets based on their risk, just to determine that how much capital bank have to hold for just stability, right? Example, suppose if borrower A has a high credit rating, so obviously borrower A is having low risk. Borrower B has a poor repayment history, so there is high risk. So bank may charge higher interest to the risky borrowers and ask them for more collateral. Collateral means security, right? So third step, we have risk monitoring and control. This is same in every risk. Credit risk monitoring means continuous supervision of loans after disbursement. That means banks check that if borrower takes the loan just to construct a home Is the borrower using that loan money in the same manner or for the same goal, or just using that money in another thing? So credit risk control means taking corrective actions if the risk increases. So what bank monitor? Timely payment of interest and installments, account turnover, stock statement, and early warning signals. That is credit risk monitoring and control. Right? You can take the example. Suppose in credit risk monitoring and control, some frequent examples are there, like delays in the EMI payment, check bounce, excessive withdrawal. So how to control? Just restructure that loans, restrict the credit limits, increase the supervision, and classify the account as special mention accounts or NPAs. So if a business loan borrower starts delaying payment, bank have to flag that account into the special mention account, or bank increases monitoring and restricts any further credit. That is the thing the bank can do, right? Now fourth step is credit risk mitigation, just to reduce the impact of credit risk. What are the common techniques? Start taking collateral, start taking guarantees, credit insurance, diversification of the loan portfolio. And what are the types of collateral? Obviously land, building, fixed deposit, shares, securities, gold. That is credit risk mitigation, right? So credit risk always arises due to borrower default, managed through identification, measurement, monitoring, mitigation. And strong organizational structure always ensures effective control. What is the aim of this? Just to minimize the losses and ensures the bank stability, right? So if bank is giving a loan of 10 lakh against a property worth 20 lakh, if the borrower defaults, bank can sell the property. So loss is minimized. Now, what is the structure? Who are there? Who are behind this credit risk management? Effective credit risk management requires clear organizational structure. So first we have board of directors, the ultimate top prior level board of directors, who are completely responsible for credit risk, who approve credit risk policies, who sets the risk appetite, like willingness of a bank, that a bank can take that much risk. So board decides maximum exposure to one borrower or one sector. That is the decision of the board, and everybody have to follow that, basically these decisions, right? Then risk management committee, which works with the board of directors. It checks all the types of credit, it reviews the risk reports. So RMC reviews the rising NPAs and suggests the corrective measures. Then we have credit policy committee, credit risk management committee, which formulates the credit policies, which sets lending norms and limits, approve the large credit proposals. And then we have credit risk management department, who do day-to-day credit risk analysis, credit rating and monitoring, portfolio analysis, stress testing, right? So this is the structure basically. Now risk identification, we understand that thing, that recognize the risk, that how risky the risk is. That is the, like, just identifying the cause of credit risk, right? But it also have two components: default risk, in which borrower fail to make the promised payments, like partly or fully. Neither principal is paid or neither installments are paid. This is one of the most serious form of credit risk. That is the default risk, right? Then we have second one is credit spread risk, downgrade risk. In this one, even a borrower does not default, there is still a risk due to deterioration in the credit quality. Borrower is giving their EMIs on time, but migration in their credit ratings, that creates the problem for the bank. So why this deterioration leads to? When there is increase in the risk perception, when there is widening of the credit risk. This is known as credit spread risk or downgrade risk. Suppose if a company is having the credit rating AA. Due to falling profit, the rating become only A. Now investors demand high interest, and that increase in interest called credit spread risk. No type of default is there, but risk is there, right? So how to do the risk measurement? Just assessing that how much risk is there and how the risk is exposed to. Measurement of risk through the credit rating. Credit rating or scoring, just to classify the borrowers, that how much risk are there aligning with their borrowers, with the borrowers. If high rating, that means very low risk is there. If low rating, that means very high risk is there. So retail loans use credit scoring while corporate loans use credit rating. If credit score is above 750, obviously there is low risk borrower, and if credit score is below 650, high risk borrower. And here we can say how to quantify the risk through the expected loan losses. How to quantify that? Through the expected loan losses. So basically, what I told you, expected loss is equals to probability of default, LGD, multiply by EAD. Right? Now, probability of default, loss given default, exposure at default. Suppose this helps bank to price the loans properly, maintain the capital, and also make the provisions. Right? Credit rating, why this is necessary? Obviously that tells about the borrower, that tells about the borrower will default or not. It helps in better risk based pricing. It is as an early warning of deterioration. It helps in portfolio risk management, and also it also tells that there is regulatory compliance or not. If a borrower having AAA rated credit rating, that means very low interest rate will charged by the banks. But BBB rated borrower, higher interest rate is there. So what are the credit rating parameters? First, they check the financial parameters. Then they check the management parameters, industry, about the business parameters. These are the parameters basically checked when the credit rating is assigned to a borrower. And to actively manage the credit portfolio, bank have to check the credit rating models. Bank must have the credit rating models. Means there are the separate models for the corporate loans, for the MSME loans, and as well as for the retail loans. And home loans model are differ from obviously the finance model. And the bank also have rating migration data. Rating migration data means where bank develop and maintain data on the borrower defaults. It also tracks the movements of borrower across the rating categories. That movement is called rating migration. Right? So if borrower moves AAA to triple B, it did obviously it indicates that the credit quality is deteriorated. Right? Okay. Now what are the credit policies and guidelines at the transaction level? First is credit appraisal process, because transaction level tools, they are used to control the risk in the individual loans, on single basis loan, individual loans. Now credit appraisal process, where the systematic evaluation is happened with the loan proposals before sanctioning them, before approving them. It banks check what is the purpose of loan, is there repayment capacity or not, what is the security, is the loan is following the compliance like rules and regulations. Next step is risk analysis process. Risk analysis process, like identifying and assessing the risk are related to the borrower, their business, their security. And credit audit and LRM, loan review mechanism, in which independent review of credit decisions and the portfolio quality. Portfolio quality means basically it checks that what is the decisions of credit decisions, which detects the weaknesses and also ensures the policy compliance. And then monitoring process. Monitoring process, you can say, in this it tracks, continuously tracking the borrower performance after disbursement. Either the borrower is using the loan money in the right place, by checking that borrower is able to give the EMI, the stock statement of the borrower, the financial results of the borrower. So what is risk identification? Just default risk plus credit spread risk. What is risk measurement? Rating plus expected loss estimation. Credit rating depends on financial management, industry and business factors. But transaction level tools ensure loan quality and early detection of stress. Right? Is that clear? Okay. Now, credit control and monitoring at portfolio level. Credit control and portfolio level means when monitoring the entire loan book of the bank. That checks that is there any chance of risk anywhere in this. They check and identify the portfolio. Portfolio means together. Credit weakness in advance, which generally done by the credit quality migration. It checks that if any borrower is moving to the another category or not. It why it is important? Because early signs of future NPAs, if any account become inactive for more than 90 days. And also banks take the corrective actions. Obligor specific risk, when risk is related to a single borrower. Right? Portfolio risk is when the risk are from the every different borrower. So that's why banks policies are saying that don't keep all the eggs in one basket, means don't give the all loans to only one sector. Bank also analyze how much exposure is there in AAA, in AA, in only single A, in triple B and below the investment grade. Right? And bank fix this maximum limits also. Banks also checks according to the industry value, industry reputation. Then we have CVAR. That is the term which tells about credit portfolio value at risk. What does this means? It maximizes the potential loss on the loan portfolio over a given time horizon at a given confidence level. Let me tell you with the help of example. Suppose if this credit value at risk is rupees 500 crore at 95% or 99% confidence. So that means there is only 1% chance that the loss will exceed this 500 crore. Or that thing is helping in like capital planning, risk pricing, or stress testing. Right? Then, what is the meaning of active credit portfolio management? Active management always means just buying this credit exposure, sell, transfer, restructure when the problem is there or any chance of problem will be there, instead of holding them till the maturity. And that's why this credit portfolio management is needed, because large corporate borrow directly from the capital market, from the bonds or CPs, commercial papers. That's why bank lose high value, high quality of borrowers who are good. Right? And also there are capital mobility, lower returns are there, and high risk awareness is important. Most important thing is that loan review mechanism, which is a review of loan account that access what is the quality of the asset, is policy compliances are there, everything is according to the policy rules or not, or any early stress signals are there or not. So we have very important aspects in the loan review policy. What are the aspects? First, qualification and independence, because reviewers must be, that is important, that reviewers must be skilled and they are independent from any sanctioning authority. They don't have any type of connection with the sanctioning authority. And if there is any large or risky account, that type of accounts needs frequent reviews. Or in the case of retail loans, only sample based review is enough. And what should be checked in the review? What is the financial stability? What is the security valuation? Like what is the valuation of that security? Is the borrower is able to follow the rules or not? And also review of the small retail loans by the automated tools or by the portfolio level analysis. So that is the objective of LRM, in which first they do the early identification of the weak loans, then they evaluate the portfolio quality, then they do help in they checks the loan loss provisioning, and everything must be according to the rules and regulation, and then they provide every report to the top management. So here we can say that what is LRM? Just the credit audit. Portfolio risk is not equal to the individual risk. And securitization improves liquidity, capital adequacy, and also risk diversification. Right? Now, here let's learn about credit risk mitigation. What is credit risk mitigation? As the name is saying about the mitigation, that means reducing or transferring the credit risk to the another party, right? And what is securitization? Converting the illiquid loans into the tradable securities through an SPV. What is this SPV? Special purpose vehicle. What is the meaning of this SPV? Special purpose vehicle, a separate legal independent company which is generally created by the parent company. Why? To isolate the financial risk, to manage the specific assets, or to execute any type of distinct project. Right? And what is the process of securitization? Bank pool similar loans, bank transfer them to this SPV, SPE. SPE issues pass through certificates. Investor buys these certificate. Cash flow from borrower pass to investors. So what are the types of these securitization exposures? Simple: asset-backed securities, mortgage-backed securities, credit enhancement, liquidity facilities, interest rate currency swap, credit derivative, and tranched covers. So you can see that here. What is MRR? Minimum retention requirement. What is this? RBI prescribed these MRR if loans are here below the 24 months, MRR must be 5%. If loans are more than 24 months, MRR should be 10%. And for residential mortgage loan, MRR should be 5%. Right? And here, what is the meaning of credit derivatives? Credit derivatives, these are the financial contract. Credit derivatives are the financial contracts in which credit risk is transferred from one party to another party without selling the actual loan or bond. Without selling the actual loan or bond. Right? Underlying asset remains always on the balance sheet of the original lender. This is a bilateral agreement. Risk is transferred here, not the assets are transferred. Only the risk is transferred. So if suppose bank give 100 crore loan to company A, bank fear about the default risk. Bank buys here credit derivative. If company A default, another party bears the loss. So we can say that credit derivatives were used only for protection, for hedging, and later these are also used for trading and speculation. That is the same thing, collateralized loan obligations. CLOs are the securities which are backed up by diversified pool of loans. Lots of loans. Right? So why credit derivatives are used? Just to transfer the credit risk without selling the asset. Just to get protection from the credit risk. And reduced risk means, obviously in that case, if the risk is not there, low risk is there, so bank have to maintain low capital. And that helps in better portfolio management. Right? And for the protection sellers, it gives them premium income. They earn premium without any loss. They do the arbitrage, like they buy the securities from one market where the prices are low and sell them to the another market where the prices are high, right? But what is the meaning of this protection buyer and protection seller? Like, what is the meaning of this protection buyer and protection seller, and why this term is used here? See, protection buyer and protection seller, you can understand like this. Protection buyer is an investors in the credit default swap. Basically, these are the investors, buyers are the investors or the lender who pays a periodic payment on transferring the credit risk of any debt instrument to the protection seller, right? And protection sellers are those basically financial institution who receives these payment and compensate the buyer if any type of default or credit event occurs. So protection buyer generally are the risk hedger and protection sellers are the risk taker. Okay, so that is the concept of protection buyer and seller. Then CLNs, credit linked notes, they are on the balance sheet instruments that combines a bond and a credit derivative. And credit spread options that basically protect against any type of widening of credit spread, like spreading of the credit risk. You can take the example, if bond yield increases from 8% to 10%, credit spread here widens. So option pay compensation, settlement must be happen in cash or physical settlement. And one more thing is there about the total return swap. What is total return swap? Where the total economic return of an asset is exchanged without owning the asset. Example, if suppose bank owns any type of corporate bond, investor here receives interest, also the price, whatever the price change. Investor here is not owning the bond. So total return swap is an off balance sheet replication of an asset, right? So that is the concept of TRS. And there are some hedging things which is very important, just use for protection. What some hedging techniques or things you can say, like product must be according to the need of the client, whatever the client is there. Everyone have to understand the market problems, what are the basis risk involved in any type of transaction, and also documentation, because a good documentation process include clear term sheet, strong internal communication, and also they are able to understand the objectives. Our module B, unit 16, operational risk and integrated risk management. So let's start with this class. I am hoping that I am audible, my screen is visible. So if I tell you about operational risk, this is the risk that is one of the most dangerous risk. Why? Because this risk occurs due to people, process and some external events which are beyond the control of bank. So according to the Basel Committee, operational risk is the risk of loss which is arising from inadequate or failed internal processes, people, system and external events. Now, internal process failed in which like employees do fraud or employees do any type of like mis communication or any type of mistakes in recording the transaction or anything that is come from the people side, that is we can say it's a human error. So that is the failed internal process or people error. But if we talk about the system that is technologically glitch or which disrupts the operations of a business in daily life, right? Maybe power issue, or like printer is not working, or there is no work of the technology is not working, like windows are not working, external events which are beyond the control of bank, like natural disasters as well as some situations like COVID-19 pandemic. So in this we can't include credit risk and market risk. Operational risk is just occurs due to people, systems and external events, right? So why the operational risk arises? Operational risk arise due to deviation from normal and planned functioning. Maybe if plan is implemented in a business but there are some deviations in that, or anything which is not completed in the business, so from these issues operational risk arise. Error by employees, maybe intentionally or unintentionally, failures of system or technology, weak internal controls, natural or external events which are beyond the control, that all are the example of operational risk, right? That all are the examples of operational risk, or we can say that these are the operational risk. Now operational risk, we can say that in simple terms is the risk that arises when day-to-day operations of an organization do not work as planned due to human mistakes, weak procedures, technology failures and some external disruptions. These all are the examples of operational risk. That's why the operational risk arises, right? Okay. Now we can take the example of the operational risk if I explain you with the help of examples. Suppose if a bank employee that enters the wrong account number, that will cause financial loss. ATM network crashes. Why? Due to say server failure. Any fraud committed by an employee. Flood damages a branch and destroys the records. That all are the example of operational risk, right? Okay. Now operational risk is classified here in the Basel II. Basel II classifies operational risk based on cause based classification. Why the risk occurred, what is the cause, effect based classification, what loss occurred due to the risk. So cause based classification we include in this people oriented causes. Now where the name of people is there, that means when the risk arise due to human behavior, capability or integrity issues. Due to human behavior, capability or integrity issues. That is people oriented causes. When the risk arise due to human behavior, capability or the integrity issues, right? Okay. What are the key causes? See, when there is not proper attention by the management, they are not taking good decision, negligence. There is not proper enough skilled peoples are there, they are not able, incompetence. Employees, they are not properly trained, they don't know about anything or any updated things, updated news, insufficient training. Fraud, dishonesty, unethical behavior, these are the example of integrity issues. So over dependence on one critical employee, that means key man risk. Everyone is depend on that employee, that employee will handle that situation. So these are the examples of people oriented causes. When an employee approves a loan without proper verification, so obviously operational risk is there, but credit risk is also there. Cashier miscounts cash due to carelessness. Senior IT experts leave the company and no one knows how to operate the system. Employee commit internal fraud by manipulating the accounts. So these all are the examples of people oriented causes. But what is the meaning of process oriented causes? When the risk arises due to complex or poorly designed business processes. When the risk arises due to complex or poorly designed business processes. Not a good management system is there, not able to make good decisions, not able to make the plans according to the vision, especially during the transactions. So if business volume fluctuate, that means if sudden increase or decrease in the transactions, that cause the process oriented cause. Too many layers, too many departments are there in the organization that confuse the authorities. Very complicated financial products are there, or any major change occur like merger, new systems, or any type of restructuring. These all are the example of process oriented cause. Right? Example, suppose error increase during the banking peak hours due to heavy transaction load. Mistake happens during implementation of new loan project. Operational failures after the bank merges, or incorrect processing of derivatives due to product complexity. These all are the example of process oriented causes, transaction based. But we have also process oriented causes but operational control based. These risks arise due to weak internal control. When the internal controls are weak, and supervision, when nobody is able to supervise the employees, nobody is there to give right direction, very weak controls are there, everyone doing their own work without consent. So when same person handles multiple critical tasks, obviously that cause the operational risk. When there is no management supervision, when there is inadequate or unclear policies, these all are the causes of process oriented causes, operation control based. Here we can take example. Suppose if same employee records and approves transaction that leads to fraud, right? Or if no review of daily reconciliation statements, employee follow outdated and unclear operating materials. These all are the examples of operational control based process oriented causes. Got it? Okay. Now technology oriented causes. Obviously when the technology fails, when there is a failure or weakness of IT system and the technology. These risks arise due to failure or weakness of IT system and technology. Very poor technology, outdated technology, not able to manage or run the current technology, very complex information system, poor system design, development and testing. Nothing is according to the updated things. These all are the examples of technology oriented causes, or we can say core banking system crashes during business hours, technology risk. Data loss due to server failure, technology risk. Software bugs cause, and that software bugs cause incorrect interest calculation, technology fails. Cyber attack due to outdated security system, technology risk. So these all are the example of technology oriented causes. Now what are external causes? These risks arise due to events which are beyond the organization's control, like natural disasters, flood, earthquake, fires, third party failures, outsourcing vendor failure. Third party is not able to do the things or not able to fulfill their obligations, or any type of political or social instability. These all are the causes of external causes. Or we can take the example like external causes examples are flood damages, the branch premises and documents, as well as payment gateway failure of an external service provider. There are riots that disrupt branch operations, strikes, government policy change which affects the operations suddenly. So these all are the example of the external causes, right? So we can say that operational risk is failure of people, process, system or external events. Cause-based classification explains why the risk occurred. Effect-based classification explains what type of loss occurred. So strong control, training, technology, supervision, they help in reducing the operational risk. Right? Now let's learn about the effect-based. Effect-based classification focuses on the type of loss suffered due to this operational risk. First we have legal liability. When penalty is there from the government side or like legal action or court cases, customer sues the bank for wrongful debit. Compensation paid due to breach of contract, that is legal liability. Regulatory compliance and taxation penalties, loss due to violation of laws, regulation or tax rules. If someone is not following the rules and regulations, that basically causes the penalties. So if any penalty imposed by regulator for KYC violation, fine or late submission of regulatory returns, tax penalties due to incorrect reporting, these all are the example of effect caused classification. Any assets are damaged due to theft or any type of physical damage, fire that destroys the branch building, theft of cash or equipment, damage to the ATM machines. These all are the example of effect based. Now the most important term is restitution. When money paid back to the customers just to correct an operational mistake. If any refund happens of any excess charges that is wrongly debited. Compensation paid for service failure. Then loss of recourse. Loss occurs when the organization cannot recover money from another party. Right? So that loss recourse is when the organization cannot able to recover the money from the another party. Like failure to claim insurance due to missing documents, legal right loss due to late actions, write downs when the value of assets are reduced due to operational failures, writing off bad loans due to documentation error, reduction in asset value due to system misclassification. These are come under the write down. Now the most important thing, what are the principles to manage this operational risk management. Because in every risk management, we have to identify the risk, we have to control the risk, we have to monitor the risk, we have to reduce the losses which is arises from people, processes, system and external events. Right? First principle we have, what should be the responsibility of the board of directors, because we know that board of directors are the top authority. They are responsible to manage the operational risk. Board of directors are ultimate responsible for ensuring that a strong operational risk culture exists across the entire bank. Risk awareness must start from the top. Ethical behavior, compliance, accountability must be promoted. Board sets the tone at the top. So if a board insists on zero tolerance for fraud and regularly reviews operational loss reports, employees will take control seriously. So board of directors are the ultimate top authority who are responsible for strong operational risk culture. Then we have principle 2. Principle 2 is telling about choice of operational risk framework. Choice of operational risk framework means, what is the meaning of this? Each bank have to choose their ORM framework based on what is the size of the bank, what is the nature of the business, what is the complexity of the operations, what is the risk profile. Because one size fits all, that is not the approach here. Small banks need simpler frameworks, whereas the large banks need advanced systems. So if a small cooperative bank may use basic risk registers, while a large commercial bank use advanced risk analytics software. Right? Then principle 3 is about oversight of senior management by the board. Now, board of directors are okay, but senior management also having the responsibility, because board of directors can't do everything. So they choose the senior management that whatever I told you, you have to implement. Either the policies and any decision making levels. Board does not manage daily operations. Board ensures effective implementation only. Continuous monitoring is required, which is the work of senior management. So board reviews whether branches are actually following KYC and internal control procedures are approved by management or not. Then principle 4, risk appetite and risk tolerance. What is this risk appetite? Willingness of a bank, that a bank can take that much of risk. And what is the meaning of risk tolerance? The maximum acceptable deviation from that appetite. And board of directors are responsible to approve and regularly review a risk appetite statement for operational risk. So bank decide it will tolerate operational losses up to 5 crore per year, or any breach beyond this trigger immediate corrective action. Then we have principle 5. And principle 5 is all about governance structure by the senior management. Means senior management have to design a very clear, transparent, strong governance structure for ORM, for operational risk management, and have to approved by the board, which defines all the roles and responsibilities. No type of double mean like ambiguity is there, no overlap should be there. Branch managers manage the branch risk. ORM department monitors the risk. And internal audit, they checks the control independently without any pressure. Right? Then we have principle 6. And principle 6 is all about identification and assessment. Identification and assessment of operational risk, in which senior management are responsible. They have to ensure that all the product, activities, process, everything in an organization, system, processes, they are assessed properly to check that is there any operational risk exist or not. So in this, basically they identify the risk, they understand the risk driver, they do the risk assessment. Example, before launching mobile banking, risk like cyber fraud, system failure, data theft, they must be assessed. Right? Then principle 7, approval process for new products and systems. All the new product, services, system, processes, they have to go through a formal approval process that evaluates the operational risk. All the new product, services, system, processes have to go through a formal approval process through that evaluates the operational risk. Because no product launch without risk assessment. It includes IT, legal, compliance and operational review. So before introducing any type of UPI service, bank evaluate transaction failure risk, fraud risk, customer grievance handling capacity. Right? Principle 8, monitor the risk profile. And senior management are engaged here. They have to monitor operational risk. They have to check that what is the exposure of the operational risk and the loss trends. Just a second. Sorry. So, what are the key tools here? Key risk indicators. Now, what is the meaning of this key risk indicators? Key risk indicators, you can just think like these are the indicators or the metrics that provide early warning sign for any major risk, any type of major risk like credit risk or market risk or operational risk, liquidity risk, compliance risk, that gives the early warning signs. Right? So key tools are key risk indicator, loss event databases, risk dashboard. If ATM cash out incidents are increasing, management investigate the causes and strengthen the control. Right? Then we have principle 9. Total 13 principles are there. 13-12 principles are there. Principle 9 is telling about do the strong control environment. Environment must be controlled, strongly controlled. Bank have to maintain strong internal control. How? with the help of policies, with the help of procedures, with the help of systems. They have to transfer the technique, they have to do the risk mitigation. And what are the risk mitigation tools? Everyone must know their duties. Maker checker system. One makes the entry, checker have to approve the entry. Insurance. And also outsourcing control. So cash handling is ensured and dual control is used to reduce fraud risk. That is the basically include in the strong control environment. But if all the things are there, principle 10 suggests, then okay, you are doing these all things, but very important thing is business continuity. Business continuity is most important thing. Means bank have to make their business continuity plans and also the disaster recovery plans to ensure that no one can interrupt their business during the stress events, during the crisis. Any type of natural disaster plan should be there. Any type of cyber attack, power or system failure, pandemic situations. So during flood, bank switches operations to alternate data center and continues the customer services. Right? Principle 11, do the public disclosure. Obviously public disclosure, that is the basal third pillar also. That do sufficient public disclosures. So stakeholders can assess operational risk exposure, risk management practices. Stakeholders have to include depositors, investors, regulators. Annual report discloses operational risk figures, risk framework and control measures. Then next principle is principle I think principle 10 is done, principle 11 is done. So these are the principles basically. So in this I can say that board is responsible for setting the tone, risk appetite and oversight. Senior management implements the board policies. Operational risk management department monitors and measures the risk. Internal audit independently reviews the control. And strong control, business continuity plans and disclosures are there. That means there is an effective ORM. Right? Now, management overview and organizational structure. Whenever the organizational structure, we have to first include board of directors. They are responsible to set the risk appetite. They are responsible for reviewing the operational risk performance. They are responsible for overall ownership of ORM framework. They are responsible for ensuring compliance with the Basel norms. So board reviews quarterly operational risk report and major loss incidents. Then what is the role of operational risk management committee? They identify the operational risk. They frame the policies by the board. They set the risk assessment and measurement guidelines. They ensure the adequacy of control. So ORMC identifies rising cyber fraud risk and recommend strong authentication control. And what is the work of operational risk management department? This is the nodal department. They do the risk identification and assessment. They do the loss data collection. They do the risk measurement and reporting. They do the coordination with business units. So ORM department maintains a database of fraud, system failures and as well as of human errors. And same we have the role of internal audit. In internal audit, you can say that when the auditors do the audit assessment audit without any dependency, and in the business functions, they own the risk in their operation, they do the first line of defense, they have to protect their business only. That is the business function, right? And here we can say implements the control. So branch operation team ensures daily reconciliation to prevent the losses. Now, how is the process work? Mapping of processes and identification of risk and control. Bank are responsible to identify that what is the problem and how that problem must be controlled. Why the process mapping is important? Because it helps in identifying weak point, it improves control design, it reduces chance of operational risk. Example, loan processes, credit appraisal, wrong appraisal due to incomplete documents. So how to control these things? Just make a checklist and then do a second level of verification. Then mapping keep business processes into sub processes, processes into sub processes. Every major activity should be divided into smaller steps to identify the risk more accurately. Example, cash loading, reconciliation, monitoring, vendor servicing. Risk is cash storage or access. Control is daily reconciliation and do the surprise check. Right? And qualitative approach to aggregate and assessing operational risk. This approach relies on judgment, experience and expert opinion. This approach relies on judgment, experience and expert opinion. That what are the risk identification workshops are there in the business or in the banks? How the departments do the self-assessment? What is risk and control self-assessment, which is also called RCSA? Right. So you can say that RCSA is a complete structured process where business units identify, assess and monitor their operational risk and control the effectiveness. Branch manager rate risk as high, medium, low. That must be based on the experiences. Then scorecard approach. Bank use a scorecard system to give the score that like cash fraud is very high, impact is also high, score is high. System downtime likelihood, maybe that may happen in 1 year or 2 years. Impact is high and score is medium. Then here one more is missing, that is we have quantitative approach. Quantitative approach in new product processes. Because before launching any new product, bank have to check the numerical impact of operational risk. Before launching digital loan app, just imagine about the expected transaction volume, expected failure rate, estimated loss amount. Right? Now, risk monitoring and control practices. how to control and how to monitor the risk. First, do the collection of operational risk data. Bank have to record all the operational loss event, including fraud, system failure, human error. If any wrong interest charge, customer complaint, refund is done, that must be recorded. Regular monitoring and feedback mechanism means here bank have to continuously monitor risk trends and provide the feedback. Suppose ATM complaints are increasing, corrective actions are taken, so it must be that is important to give the training to the staff. Frequency and probability analysis. Incident data is analyzed to understand that how often risk occurs and what are the chance of probability. Means if check return error occurs weekly, that means risk probability is high there, right? And monitoring the large exposure, in this we can include that loan policy documents must be there, in this focus on high value transaction is especially required and on the large loans, whereas any loan policy document they have to specify approval limits, monitoring mechanism, reporting requirement. So if any loan is there which is above 50 crore, that required board level monitoring, right? That required board level monitoring. Now, how to do calculation for operational risk according to the Basel II. First, we have basic indicator approach, one of the simplest, one of the approved, most used method, where 15% of average positive gross income of last 3 years is multiplied by average gross income. Gross income means whatever the income is generated from the banking operations. So you can write gross income multiply by the beta factor, right? And what is the meaning of standardized approach, in which 8 business lines are there and their risk level and beta factors are given, and you have to learn this. All the 8 business lines are given and each is having different risk level. Third, we have advanced measurement approach, AMA, and this approach basically is the most advanced approach because bank have to use their internal risk models which is approved by the regulators, and bank model losses from cyber fraud, they have to use history and any industry data, right? This is the third approach, which is most advanced approach. Okay, now how to mitigate the operational risk? Just by reducing the impact and probability of the operational risk. And what are the key mitigation method? Strong qualitative framework, policies must be strong, procedures must be strong, training must be there, internal controls must be there. Maker checker system reduces the fraud risk. Bank use AMA method and can reduce the capital requirement by recognizing the insurance. Insurance benefit capped at 20% of total operational risk capital. So if total operational risk capital is 100 crore, maximum insurance benefit must be 20 crore. And yes, insurance have to follow the rules from the approved insurers, must have minimum residual maturity, must have to clearly cover operational risk events. And then we have key risk indicators. As I already told you about the key risk indicators, what is the meaning of key risk indicators? These are the metrics who gives the early warning signals that tell the bank whether operational risk is increasing or under control. They measure risk causes, why the risk occur, what actually happens, what are the risk consequences. So KRIs help the management take the preventive action before losses occur. Why it is important? Because it gives the warning sign. It helps the management to monitor risk trend. It supports timely decision making. It improves internal control. And what are the characteristics of good KRI? They are easy to measure, they are timely and relevant, they are linked to key processes, and they are action oriented. And some examples of the KRIs we can take: inadequate staffing. Inadequate staffing means shortage of staff increases error and fraud risk. So what should be the indicator? Vacancies exceeding approved strength, single employee handling the cash reconciliation, obviously that will lead to the high fraud risk, and too many suspicious transactions, too many complaints. So that all are the example of KRIs. These are the early warning signals. Now, integrated risk management. Integrated all the types of risk together across the entire organization instead of managing them separately. It covers credit risk, market risk, operational risk, liquidity risk, reputational risk. Also it is called ERM, enterprise risk management. Why it is needed? Because it aligns the strategy with daily operations. It improves the transparency. It enhances the revenue and earning growth. It controls the downside risk. So what are the challenges are there in the integrated risk management? Are there any challenges? Yes. There are real-time concerns. Means risk data not available instantly. If delays are there in reporting and analysis, any type of business challenges, so balancing growth with risk control, resistance from the business units, and cultural issues, lack of risk awareness, employees see risk management extra work. So here integrated risk management, this built on only 4 pillars. Strategy must be good, and risk management must be the part of core corporate strategy. Chief risk officer must be appointed. They are the head of the risk management. They coordinate all the risk function. They directly able to report managing director and CEO. And board have to tell about the authority of the CRO, independence and reporting structure. Process. Risk process must be common across the enterprise. It includes risk identification, risk assessment, risk control, risk financing. So same risk assessment framework used for loan, IT, HR and treasury. Then systems. Bank have to use technology based risk management systems in which risk data collection, risk dashboard and also reporting and the analytics. And one important thing, KRIs are the early warning indicators of the risk, whereas integrated risk management, which manages all the risk together. And what are the benefits of the IRM? Transparency, growth, risk control. And what are the challenges? Real time data, culture, business pressure. An IRM approach is just strategy must be there, organizations must be there, proper peoples are there, process and system. And CRO is the key to the IRM success.
Imagine this situation. Your bank is profitable, balance sheet is strong, assets are more than liabilities. But today morning, depositors are standing in a queue, and then bank says cash is not available. Is this is a loss problem? No. Is this bad management? Not exactly. This is liquidity risk. Remember one line. Banks don't fail because they are poor. They fail because cash is not available at the right time. One delay in payment, one mismatch in maturity, and the entire trust of customers collapses. So, today let's understand what exactly is liquidity risk, why profitable bank collapse, and how banks manage liquidity to stay alive. So, hello everyone, welcome here. Good evening. I hope that I am audible, my screen is visible, everything is okay. So, let's start with the class where we will learn about the liquidity risk management. So, this is the Telegram channel. You can join it where you can ask questions and also you got some quizzes, questions. So, liquidity risk management. If I talk about the liquidity, when the enough cash is available, that is called liquidity. When banks are easily convert their assets into the cash is called liquidity. But when the banks are not able to fulfill their obligation due to shortage of cash, that is liquidity risk. And that's why liquidity risk is called ICU of the banks. Liquidity risk means ensuring that bank always has a enough cash or liquidity assets so they can meet their obligations on time. Either by raising their funds or by converting their assets into the cash quickly without heavy loss. So, a bank may be able to pay the depositors when they ask for money and meeting loan disbursements and expenses smoothly. That is called liquidity risk management. If many customers are withdrawing money suddenly, the bank should have cash or asset like government securities that can be sold or pledged quickly. So, why the need of liquidity risk management is there in the banks? And what is the importance? Solvency versus liquidity. If a bank is solvent, if its net worth is positive, bank is solvent if its net worth is positive. But a solvent bank can still fail if it has no liquidity. Example, if a bank may own long term loans worth 10,000 crore But if it has only 100 crore cash and depositors demand 500 crore, that is liquidity crisis. And proper liquidity management helps avoiding any type of emergency borrowings at the high cost, maintaining the public confidence, improving the profitability, and ensures long-term survival. If a bank plan liquidity well, so obviously they can invest surplus funds or here, which keep the excess idle cash in waste. Instead, bank invest them into different activities so they can earn the profit. So first thing is solvency versus liquidity. Liquidity is a very critical things for the banks, and profitability and long-term survival is the need for every business. Or you know that thing. If all the depositors came and they just want their money, no strong bank can survive in that situation. And by chance, if any bank said that thing that there is no cash available, that creates the panic situation. And that panic situation leads to the reputational risk. And reputational risk is also dangerous for the bank because lots of depositors come at the same time, which creates the problem for the bank, and bank is not able to survive that moment. So the result, that bank will collapse. So what is the role of banks? Are the banks are liquidity providers? Obviously, bank provide liquidity to the depositor. They can't say to the depositor that cash is not there. They can't say to the borrowers that cash is not there after disbursing the loans. They can't say financial markets that the loan is not available or the money is not available. So that's why liquidity risk management is very important. Proper liquidity risk management is very important. So, what are the problems in managing the liquidity? What are the problems actually bank face? First, there are types of liquidity required. Operational liquidity. Why? For completing the daily operations of the business, like ATM withdrawals, check clearances, reserve liquidity, any unexpected needs, money should be there. Sudden withdrawal by large customer. So obviously bank should must have the money for that situation. And for any crisis situation, example financial market disruption. So types of liquidity are there with the banks. So bank have to manage these types. And what is systemic risk? When the one bank fails, that leads to the other bank also fails. That affects the entire financial system. Failure of the large bank cause panic withdrawals in other banks too. That is called systemic risk. So liquidity risk is important not only for banks but also for the RBI, for the regulators. That's why LCR, NSFR are prescribed. What is this? We will discuss. So, first issue is operational liquidity. Then you can say uh, impact of market and economic changes. Means what are the changes of impact of market and economic changes? Interest rate changes, inflation, economic slowdown, financial crisis, During the recession, loan repayments slow down. We know that. And in that case, liquidity pressure increases, right? And also, any type of availability, accessibility, and cost of liquidity. Because liquidity should be easily available, quickly accessible, at the reasonable cost. Because borrowing overnight from the interbank market may be easy, but costly during the stress time. And there should be early warning systems. Early warning systems for what? There should be the systems are there in the banks who can detect the liquidity stress before it becomes serious. And what are the examples of that? Sudden fall in deposit and too much dependency increased on short-term borrowings, right? People are taking loans via mobile apps like MobiQuick, and some apps are there who gives the short-term borrowings, and also frequent use of RBI borrowing facilities. That all are the situation creates the liquidity risk problem. And if people are doing this thing on regular basis, that is the early warning signs for the bank. And that does not mean that the bank is having the plan that is enough. No, bank must be able to execute liquidity plans quickly. So, like selling the government securities during the crisis is also a good option for the banks. For that, banks have to maintain this government securities. So that are the issues we can say are available in managing the liquidity risk. So liquidity risk management is critical for bank survival. Even profitable and solvent banks can fail. Why? Due to poor liquidity. That's why it is called ICU risk for the bank. Effective system, early warning indicators, contingency plans, like plans for the future uncertain events are essential. And internal mismanagement is there, or any external shock that can obviously trigger liquidity issues, right? So, what are the potential liquidity risk drivers? Liquidity risk arises due to internal and external factors. What are the internal banking factors? High off balance sheet exposures. High off balance sheet exposures. Guarantees, LCs, derivatives, they can suddenly turn into the cash obligations. A bank guarantee is invoked, immediate cash outflows there. And when banks are depend on short-term wholesale deposits, even customers are depend on short-term wholesale deposits because corporate deposits are highly volatile. A company withdraws 1,000 crore overnight. This is a liquidity shock. And asset liability mismatch. This is basically called negative gap because liabilities mature earlier than the assets. Deposits that are due for 1 year, loan recoverable after 5 years. So there is a mismatch of 4 years between them. And that is the problem which creates issue for the banks, right? So now let's learn about rapid asset expansion. What is it? fast loan growth without matching deposit growth. Means banks are interested in just lending without having any funding. They are just lending the things. So that is a liquidity stress problem. And too many deposits maturing at the same time is the concentration of short-term deposits. Large bulk deposits maturing in just 3 months. That is also create problem for the banks, right? And if bank are not interested in investing liquid government securities, and also fewer long-term deposits are there, so obviously that leads to the liquidity problem. And what are the external banking factors? Sensitive financial market depositors, where depositors are interested in rumors and they just react to the rumors. If there are economic shocks like recession, inflation, interest rate volatility, and also low or slow economic growth, which reduces loan recoveries, which increases NPAs or as well as liquidity strain. NPAs, non-performing assets, basically when the account become or a loan become overdue for 90 days. So that loan become NPA for the banks. And due to the bank failure, depositors are not interested in the banks. Some non-economic factors are there, like political factors, government factors, any type of social unrest, regulatory changes, and lots of depositors they come and withdraws their money. That is also sudden massive withdrawals. These are the types of external factors, right? And unplanned withdrawal of government deposit, when government withdraw large funds suddenly. State government withdraw treasury balances, that is the unplanned withdrawal of government deposits. Is that clear? Now we will learn about just a minute, types of liquidity risk, in which first we have funding liquidity risk. What is the meaning of funding liquidity risk? When banks are not able to meet their payment obligations on time, either now or in future. Banks are not affecting their normal operations. They are just not able to pay on time. Their financial health, but they are not able to fulfill their obligations now or in future, which include expected cash flows and unexpected cash flows. Even if the bank has asset, it may not have ready cash when required. Having the asset is not a good thing. Cash is important. Example we can take here. Suppose very large corporate customer suddenly withdraws 500 crore and bank has insufficient cash. So a derivative contract require immediate collateral due to the market movement. And in this panic situation, many depositors will withdraw their money simultaneously. So what is the impact? Bank have to borrow to fulfill the demand of the depositors at the high cost. Bank have to borrow at the high cost. Or Bank have to forcefully sell their assets at loss, and also public confidence is lost, right? So there is the problem when the bank is not able to maintain their liquidity. Next type we have market liquidity risk. Where the name of market is there means banks are not able to sell their assets on the current market prices. Even the buyers are not available because market is not good at that time. Market is already disrupted. Assets are there, but buyers are not there. So obviously the price will fall sharply in that case. That is called market liquidity risk. We can take the example of market liquidity risk like government securities. Government securities usually liquid, right? Because zero risk are there, and at the time of crisis, buyer disappear. Corporate bond cannot be sold without heavy discount. Real estate, long-term loans, they can't be sold quickly. So these all are the example of market liquidity risk, right? So what is the difference from funding liquidity risk? Funding liquidity risk when the problem of cash availability, liability side issue, market liquidity risk when there is a problem of selling asset side issue. Now, what are the principles for sound liquidity risk management? According to the BCBS, we have 9-10 principles in that. First, responsibility and supervisory oversight. Bank are responsible, they have to take care, they have to manage their liquidity risk. Bank have to maintain sufficient liquidity buffers, especially high quality liquid assets. High quality liquid assets, level 1, level 2, level 2 also divided into level 2A, level 2. And supervisors, they have to monitor the banks, they have to take the action if any weakness are found. So a bank maintains access government securities just to survive a financial crisis. So principle 1 is just tell about the responsibility and supervisory oversight. Principle 2, how much risk, liquidity risk tolerate by a bank? How much risk a bank can take to earn the profit? That must be according to the strategies and policies of the business. That should be according to the role of the bank in the financial system. Like retail banks keep higher liquidity than investment banks, right? So principle third is about the role of senior management and board, the most important and most common one. Because senior management trust the uh, board of director, they have to work with the board of director, and senior management have to create the liquidity strategies and policies. Who is responsible? Senior management. They have to monitor liquidity daily. They have to report the board regularly, and board must approve liquidity policies, review them at least once in a year. So board reviews liquidity stress test results annually, right? Now we have principle 4, Liquidity in pricing and new products. Liquidity in pricing and new products means liquidity cost and risk. They must considered in loan pricing, product approval, and also performance appraisal. Business units have to bear the liquidity risk, whatever they create. So, long-term loans, if provide pricing that should include liquidity cost of long-term funding, right? Principle 5, identify the risk, measure the risk, and monitor the risk, and includes on the on-balance sheet and off-balance sheet items. Principle 6, monitoring across the entities and the currencies, meaning liquidity must be managed across legal entities, business lines, and as well as currencies. Liquidity must be managed across all these things. And if any restrictions are there on fund transfer, that must be considered. So US dollar liquidity cannot be used to meet INR obligations. US dollar liquidity cannot be used to meet the INR obligation. That is not possible. Principle 7, funding strategy and diversification. Funding should be diversified in everyone. Lots of number of borrowers. Funding should be diversified between lots of number of buyers so that risks are reduced for the lenders or depositors. Bank have to maintain the market presence and they have to regularly test the fundraising capacity, because bank should not depend on only the uh, thing that is basically corporate deposit. Bank can't depend themselves on the corporate deposit. And principle 8 is all about what? Obviously, intraday liquidity management. Intraday liquidity management, right? What is this intraday liquidity management? You can say here in this intraday liquidity management, bank have to manage intraday cash flows to meet payment, settlement obligations, important for the smooth payment systems, right? So, principle 9 is just about the collateral management. What is collateral management? Bank have to track encumbered the things, encumbered and unencumbered assets. What is the meaning of encumbered and unencumbered assets? That is the important thing. So here, encumbered assets are those assets which are basically valuable, which are owned by the person. Encumbered assets are the valuable items which are owned by the person or businesses, but these are pledged as collateral just to secure a loan. And apart from this, unencumbered assets are those assets, property, securities, or fund which is owned by the individual and that is free from any type of collateral or any type of third party creditor claims. These are free, these are properly related to the person, right? So, here that is the basically we can say encumbered and encumbered difference. Okay. So in the collateral management, we are telling, I'm telling about that bank have to track these assets. Bank have to know that where the collateral is held. They have to ensure quick mobilization. And then principle 10 is about stress testing. Stress testing is the extreme situation in which a bank must be given a extreme situation to check that how the banks will react in the case of any stressful situation. So in the liquidity stress test, bank specific stress is checked, market wide stress is checked, combined scenarios checked. Results must be used for the improvement. Right? So here we can say that in principle 10 is related to the stress testing. Principle 11 is about the contingency funding plan, emergency plan for dealing any type of liquidity crisis. And this plan must be tested and updated. In this, clear roles are mentioned, every policies, every steps are mentioned, funding sources are mentioned. So plan for borrowing from RBI or selling the liquid assets is, we can say, the example of contingency funding planning. And HQLA, bank have to maintain these HQLA. These are the assets for the bank, which is usually usable in the time of problem, and these are free from any type of legal restrictions. And principle 13 is public disclosure. What is the meaning of public disclosure? Bank have to disclose liquidity information publicly. And also it helps the market participants in assessing liquidity position. Obviously, when public disclosures are made by the bank, so obviously investor stakeholders uh, they are able to know about the stability of the banks and also the risk management quality, because disclosure of LCR and funding profile is there in annual report, so that will help the investors or stakeholders or any customer, right? So funding liquidity risk is inability to meet the cash needs, market liquidity risk, inability to sell the assets, and BCBS principles focus on governance, measurement, stress testing, contingency planning, and as well as disclosures. Got it? Now, liquidity risk management. I told you that what is liquidity risk? And now liquidity risk, how the liquidity risk is governed, who govern this liquidity risk management, and how the responsibilities are divided in the bank. So the organizational structure consists of four levels, in which first level is board of directors. And board of directors are the ultimate responsible persons, highest authority who are responsible for liquidity risk management. They approve liquidity risk management policy. They set liquidity risk tolerance. They approve the strategies and framework. They ensure the compliance with the RBI regulations. They review the liquidity positions at least annually. They ensure the banks can survive stress situation. So why the bank involvement is critical? Because liquidity problems can collapse a bank very fast. So strategic oversight must be at the highest level. If the board decides the bank must survive 30 days of stress without RBI support. So all liquidity planning will be based on this target. Got it? Okay. Now, risk management committee. Board of committees, personal assistant, or we can say the committee that helps board or senior committee of board or senior management. It acts as a bridge between board and management. It is there in between the boards and the management. So it monitors liquidity risk exposure. Also, it review the liquidity reports and stress test results. It check the implementation of the policies are there in the banks or not. It ensures that the risk limits are followed. It recommend corrective actions to the board. So if the liquidity ratios like LCR fall close to the minimum limit, RMC alerts the board and suggests the action. And ELCO, Senior Executive Committee, which fix daily works. It is the main operating body and it decides the price, handles the short term and long term gaps, manages the cash flows. And at last, we have ALM. ALM, Asset Liability Management Support Group. What is it? Basically, analytical and technical team, which provide data, analysis, reports to the ELCO. It prepares cash flow statement, it measures liquidity gaps, it conducts stress testing, it prepares regulatory reports, everything is done by ELCO. Sorry, ALM. Then liquidity risk management policy, strategies and practices. Liquidity risk management policy. Who approves? Board of directors and its delegated committee. Right? It reviews. Who reviews the frequency and how many times? Board of directors at least once in a year. And what does policy cover? Risk tolerance, liquidity limits, stress testing framework, funding strategy, and contingency funding plan. Risk tolerance, like how much risk the bank can take. Risk tolerance can expressed in quantitative limits and in the survival zone also. And then stress testing and contingency planning. I already explained this to you that what is it? Contingency planning is just basically a type of backup plan when normal funding source fails. So stress testing is the simulation of extreme but possible situations, right? So, in this, we can take the example 20% deposit withdrawn in 1 week, no access to the interbank market, credit rating downgrade, right? And what is contingency funding plan includes? A backup emergency plan when the normal funding sources fail, right? It includes emergency funding sources, asset sale plan, communication strategy, role clarity during the crisis. So, that are the parts of the contingency planning. And then, how the risk tolerance expressed in the quantitative limits and in this minimum stock of HQLA, maximum cumulative negative mismatch, and minimum LCR. Whereas number of days the bank can survive without RBI or government support is the survival horizon. And what are the types of stress covered? Institution specific stress and market wide stress. And what are the strategy for managing liquidity risk? A plan of action that how liquidity will be managed. What are the factors which are considered while framing the strategy? What is the structure of the bank? What are the business lines of the bank? What types of products are offered? What are the countries? What are the market of operation? RBI and their host country regulations. And primary source of funding, customer deposits, interbank borrowing, capital market instruments. And it is important to manage the cash outflows as well, right? It is important to manage the cash outflows as well related to daily withdrawal, loan disbursement, operating expenses, debt repayment, and it is important to manage the cash flow fluctuations, any expected or unexpected, right? So that is there in this liquidity risk management. I hope now all the principles, types of liquidity risk, meaning of liquidity risk is cleared. If any problem is there, kindly ask me in the chat box. Just do the revision of that. So now, in short, I can explain you that thing that liquidity risk governance has 4 levels. Board sets the policy and the risk tolerance. ELCO manages day-to-day liquidity. Risk tolerance include survival horizon. Strategy depends on nature, scale, and complexity. And stress testing and CFP are mandatory. Imagine this. A bank is profitable, capital is adequate, Basel norms are followed. But suddenly, market stress hits. But market stress hits, depositors start withdrawing, interbank market freezes, and the question is simple. Can the bank survive the next 30 days? Because in a crisis, profit does not matter, liquidity does. This is exactly why Basel III introduced liquidity standards. Basel III asked the students only one thing: do you have enough high quality liquid assets to survive the stress? Do you have a stable long-term funding, or are you just borrowing short and lending long? One wrong maturity structure, one liquidity shock, and even a strong bank can collapse. That's why Basel Third give us two lifelines: LCR for short-term survival and NSFR for long-term stability. Today we decode Basel Third liquidity standards not as theory but as protection against bank failure. So, hello everyone, good evening, welcome here. Today we are going to start Unit 18 Basel Third Framework on Liquidity Standards. So, let's start with the class. And here, first, we will discuss about this is Telegram channel. You can join this channel. Basel Third and Liquidity Coverage Ratio. Why the Basel Third was introduced? Because Basel 2 failed. Why Basel 2 failed? In the subprime financial crisis, Basel third failed. Many banks appeared well capitalized on paper but collapsed in reality due to poor quality capital, due to inadequate liquidity, due to too much dependency on the internal risk models. So, Basel Committee on Banking Supervision introduced this Basel third in 2010 to strengthen the global banking system. So, that Basel 3 norms have three pillars. Three pillars. First pillar is dedicated to uh, maintain adequate capital, minimum capital requirements. Pillar 2 is for the supervisory review process, and third is for public disclosures. So, what are these norms? Basically, Basel norms or Basel Accord. They are the international banking regulation which is issued by the Basel Committee on Banking Supervision. The Basel norm is an effort to coordinate the banking regulation across the globe with the goal of just strengthening the international banking system. And it is a set of the agreement by the Basel Committee of Banking Supervision, which generally focuses on the risk of banks and the financial systems. So, why the name is Basel? Because Basel is a city in Switzerland. It's headquarter of the Bureau of International Settlement, right? So Basel guidelines were released. These guidelines introduced in response to the financial crisis of 2008. It was also felt that quality and quantity of capital under Basel II were insufficient to contain any type of further risk. That's why liquidity, uh, here the two ratios which are very important, LCR and NSFR. LCR is about bank have to hold buffer of highly quality liquid assets sufficient to deal with cash outflows, and NSFR where banks to maintain a stable funding profile in relation to their off balance sheet assets and liabilities, right? So here, what is high capital adequacy ratio? Four major improvements of Basel third. Higher capital adequacy ratio. So bank have to hold more capital and better quality control. Bank have to hold more capital and better quality control. They have to focus on common equity tier 1 capital. And here also the introduction of CCB, to absorb the losses during the stress. What is this CCB? Capital conservation buffer. So, capital conservation buffer, you can just understood like this. It is a Basel third regulatory requirement that basically forces the bank hold an extra 2.5% of common equity capital above the minimum requirement just to absorb the losses during the financial stress. Right? So, if a bank faces heavy loan default during the recession, the buffer prevents immediate collapse and protect the depositors. It also reduced the variability of risk weight assets. Now the thing is there, what is the meaning of this risk weighted assets? Risk weighted assets are the bank assets or off balance sheet exposures which are adjusted to risk, which generally used to determine the minimum capital needed to cover credit, market, and operational risk, which ensures the financial stability. Right? So, bank earlier had too much freedom to calculate RWAs using internal model. Basel III limits discretion to avoid artificial reduction of the capital requirements. Suppose if two banks lending to the similar borrower earlier showed very different risk, so Basel III standardized this to improve the comparability. Right? Next, we have introduction of leverage ratio. What is this leverage ratio? Simple formula numericals are there from this leverage ratio. Leverage ratio is tier 1 capital divided by total exposure. And what is the meaning of leverage ratio? That basically a non-risk based measure which control excessive borrowing. Its objective is just to limit the excessive leverage. It acts as a backstop to risk-based capital rules. Even if a bank claims assets are low risk, it cannot endlessly borrow and expand its balance sheet. Right? So, leverage ratio, we can say this is a type of financial ratio that measures a company level of debt related to the another financial metric. Then we have liquidity standards, LCR and NSFR. In every cycle, the question is there from these two topics, LCR and NSFR. Basel third introduced two liquidity ratios. LCR, which is for short term, like for 30 days, and NSFR for long term, basically 1 year. Right? Now, liquidity coverage ratio. Liquidity coverage ratio, if I explain about the liquidity coverage ratio, what is it? In simple terms, liquidity coverage ratio is the uh, amount of liquid asset that financial institutions are required to hold by the international regulations. Right? That is called liquidity coverage ratio, which basically the minimum amount of highly liquid asset that financial institution are required by the international regulation. That is LCR. Right? So here we can say LCR ensures that bank has enough high quality liquid asset to survive 30 days of severe liquidity stress. LCR ensures that bank has enough high quality liquid asset to survive 30 days of severe liquidity stress. LCR is stock of high quality liquid asset divided by total cash outflows over the next 30 days, which is more than 100%, which should be more than or equal to the 100%, right? So that 30-day survival is not chosen randomly. It is based on historical patterns of how financial crises unfold. Most of the banks that survived past crises, they managed to hold on for about a month before government intervene in the problem, right? So basically that is LCR, high quality liquid assets which can be easily sold in the market, which can be used as collateral, which retain their value during the stress, and which are unencumbered, which are related to the person only, not obligate to the third parties. Third party can't show their like uh, that word, free from any liens, collateral, or any other thing, any type of loan or any type of collateral. So HQLAs are divided into two level. Level 1, level 2. Level 2, level 2A, 2B. Level 1 is cash, CRR balance with the RBI, government securities. In this case, basically, no haircut is applied. In level 2, low liquidity is there, like corporate bonds, lower rated bonds, haircuts applied here. In level 2 assets, 40% of HQLA applied. In level 2B, 15% of total HQLA is applied. Right? Then here we have one thing, total net cash flows must be 30 days. How can we calculate total net cash flows? Whatever the expected cash flows, these are from this expected cash inflow, we have to subtract. Outflows, whatever the money going out, inflows, whatever the money going in, coming in. So inflows are capped at 75% of outflows to avoid over dependence. Then, most important, FAL LCR, facility to avail liquidity for LCR. FALLCR. What is it? Basically, we can say that this is an RBI monitored mechanism which allows the bank to include a portion of their mandatory statutory liquidity ratio to meet the liquidity coverage requirements. FALLCR. Basically, this is a special RBI liquidity window, right? It generally help the banks to meet the LCR during the stress time, during the extreme stress. And what are the essential features? What is the eligibility? You can say it is available only under the stress situations. And bank have to first exhaust all the HQLAs, MSF eligible securities. It acts as the last resort liquidity support. And tenor must be maximum 90 days. Right? Haircut, haircut is applied here, same as the MSF. What is the meaning of this MSF? Marginal standing facility. This is basically uh, a facility by which commercial bank borrow the funds from the RBI in case of emergencies. Right? So LCR is important because it prevents sudden bank failure. It maintains public confidence. It reduces systemic risk. It ensures bank can survive short-term shocks. So, based on this, give me the answer of this question. If the bank has following HQLA after haircut, so which adjustment is required to comply with the LCR norms? What is the answer according to you here is correct? So let's see the answer. Simple. How many total, how much total HQLA is there? You can find 600 crore, 250 crore, 200 crore, which gives you 1050 crore. Right? Now, maximum of level 2 must be 40%. So, 40% of 1050 crore is equals to uh, 420 crore. Right? Now, current level 2 is 450 crore. Right? So, in that case, limits is exceed here, and level 2B is 15% of 1050, which is equals to how much? 157.5 crore. Right? That means current level is 200 crore. Here the access is also there. So maximum level 450 crore, but the here basically 450 crore is exceeding the limit, and the same in the 2B exceeds 4.42.5 crore are there. So here we can say that near about 50 crore reduces here. Approximately, we can say the level 2B assets are approximately reduces by 50 crore. It's just a basic question, right? To give you the overview to how to find these things, how to apply the haircut, right? Now, let's move to the next question. Which statement best explains the role of leverage ratio under Basel III. Which statement best explains the role of leverage ratio under the Basel III? Simple. The correct answer is C here. Why C correct answer? Because leverage ratio is simple, non-risk based, and also prevent excessive borrowing even when assets are classified as low risk. Leverage ratio is simple, non-risk based, and prevent excessive borrowing even when assets are classified as low risk. So it acts as non-risk based backstop to the capital adequacy ratio. Under the FALLCR, which combination is correct? Which combination is correct? So the correct answer is here FALLCR is last resort liquidity, which is available only after using all the HQLAs and MSF with 200 basis point penalty, right? And maximum 90 days tenor. So the answer is it's available only after exhausting all the HQLAs and MSF securities. Option B is correct here. Now, liquidity coverage ratio. Liquidity coverage ratio ensures that bank has enough highly quality liquid assets to survive a 30-day stress liquidity scenario. Right? So this is the LCR formula in which it is mentioned that how to find LCR when asked in the numerical form, or generally it is very important ratio because questions is there in every cycle from this one. LCR and NSFR both are important, right? So let me give you the overview of this HQLA that will help you to understand about the HQLAs, right? So I explain you that thing, that what is the meaning of HQLAs. HQLAs are what? Those assets which comprise high quality assets that can be readily sold or used as collateral to obtain the funds in the range of stress scenarios, right? So we have level 1. Level 1 includes cash and near cash equivalents, right? And level 2 divided into level 2A, level 2B. Level 2A, these are less liquid assets and haircut of 15% is applied. Whereas level 2, where conversion of the assets in the cash is more difficult. So haircut of 50% is applied here. Right? Okay. So now let's learn about components of LCR. Stock of the HQLA. Stock of the HQLA. Here, HQLA are the assets that can be easily immediately converted into the cash. So that is the thing. Numerator, we have net cash outflows of 30 days. Numerator is that. Denominator is net cash outflows. And in this, we include generally uh, that expected cash flows minus expected inflows. So banks hold a minimum level of HQLA. They are not rely on the inflows, right? Now, next we have here liquidity risk monitoring tools. Liquidity risk monitoring tools. We have 5 liquidity risk monitoring tools, in which first is contractual maturity mismatch. The contractual maturity profile identifies the gap between the contractual inflows and outflows of liquidity for defined time bands. These maturity gaps indicate how much liquidity a bank would potentially need to raise in each of these time bands. Right? It identifies the gap between inflows and outflows across the time buckets. And what are the time buckets? Overnight, 2 to 7 days, 8 to 30 days, 1 to 3 months. Large negative gap, liquidity stress. It helps in asset liability management. Then we have concentration of funding. This metric is generally identify the sources of funding that are of such significance that withdrawal of which could trigger liquidity problems. And this metric is also address the funding concentration of banks by monitoring their funding from each significant counterparty, each significant product instrument, and each significant currency. So it identifies over dependence on few funding sources. If 30% of funding comes from one corporate depositor, withdrawal can cause the crisis. And available unencumbered assets. It basically provides supervisors the data of the quantity and all the characteristic of bank available unencumbered assets. Basically, these assets have that potential that can be used as collateral to raise any additional secured funding in the secondary market or from the central banks. So we can say here, what are available encumbered assets that are not pledged, that not used as collateral, that are freely available for liquidity needs. They can be used for repos or sold in the stress situations. Then LCR by significant currency. Although LCR is maintained in one currency, bank have to monitor LCR separately for US dollar, for euro, for British pound. While the LCR standard is required to be met in one single currency in order to better capture potential currency mismatches. The LCR in each significant currency needs to be monitored. Right? Then LCR, basically they detect the currency mismatch risk. And then we have market related monitoring tools. In this, we can say that this includes high frequency market data that can serve as early warning indicators in monitoring potential liquidity difficulties at the banks. It uses high frequency market indicators and they are act as early warning signals system. Now, Basel third liquidity returns. Basel third liquidity returns. So, statement on liquidity coverage ratio submission is on monthly basis, time period within 15 days. Statement of funding concentration BLR2, it is also monthly for 15 days. For unencumbered assets, quarterly, 1 month. LCR by currency, monthly, 1 month. And other liquidity ratio, monthly, 15 days. Right? So banks are required to disclose information on their LCR, obviously in their annual financial statement also. And in the starting, when the LCR was introduced, the NCR related information need to be furnished only for the quarter ending March 31st, 2015. Disclosure should cover all the 4 quarters of the relevant financial year, right? All 4 quarters of the financial year. Then we have NSFR. This is the ratio that aims in promoting medium to long term structure, funding of assets and activities of the bank. This NSFR, BCBS aims to trial this ratio from 2012 and makes it mandatory in January 2018. RBI also released guidelines in NSFR in 2015. But what is the objective of the NSFR? Just to ensure that banks maintain a stable funding profile in relation to their assets and off balance sheet activities. So, NSFR ensures long term funding stability 1 year horizon, which is ASF divided by RSF, right? So, we can, this ratio is also important. So, NSFR, you can just learn NSFR is a Basel third liquidity standard which require banks to hold enough stable long-term funding to support their assets and activities over a 1 year horizon. ASF is there in the numerator, RSF is there in the denominator. Right? Now, NSFR must be here greater or equal to 100%. Right? Okay. What is the meaning of ASF? It reflects how reliable and stable the bank sources are. It classifies the liabilities into the categories. It multiplies by the ASF factor and it add the values basically. And same, what is the meaning of RSF? So here you can think here minimum amount of stable funding a bank have to maintain based on how risky and illiquid its assets and off balance sheet exposure, right? So how RSF is computed? Take the carrying value of assets
off balance sheet items, classify them into the RSF categories, apply the prescribed RSF factor, multiply the value with the RSF factor, and sum all. Then you are able to find. So these are the categories. You can just see these categories. I will provide them in the table. An RSF for the off balance sheet items. Basically, for the off balance sheet items, here, if RSF is 5%, so in that case, these are irrevocable and conditionally revocable credit facilities are there, right? So it's better to learn this uh, off balance sheet items and for this on balance sheet items in a table that will help you to understand the thing. But in this, the most important things are HQLA, LCR, NSFR. These are the most important. So this is about this chapter. I hope that chapter basics are clear. If any problem is there, kindly do the comment. So thank you so much. Let's meet in our next class. If you like this video, give the like, subscribe to the channel. Let's meet in our next class. Till then, take care and have a good day all. Thank you. With this, we come to the end of our discussion on risk management in Module B. I hope the concepts discussed have helped you understand the importance of identifying, measuring, and managing the risk in banking. These fundamentals are not only important for exam but also for practical decision making in real banking scenarios. So, thank you for your time, attention, and active participation. We will continue with the next topic in the upcoming session. Thank you and all the best.